A very good morning. Welcome, everybody. It is the last trading week of the year for real. And what an incredible week ahead we have. Good morning, Mini Cooper. How are you?
Good morning, Rich. I'm very good, thank you. How are you?
Yeah, it's very exciting to have you on the show 2 days running.
I was on last week, Monday, Friday, and I'm here again. So 3 times in 6 days.
This is incredible. But can I just let you know that you weren't first choice for today?
Who was?
Well,
Ward.
ladies and gentlemen, we have a traitor in our midst. Just look at this. Chris Beecham today deserting us to go down the road to Bloomberg to be on Bloomberg. IG Group Chief Market Analyst. Well, IG has a better television show, so why are you on Bloomberg, Mr. Beecham? Not happy about this.
Rich, can I say, why does Beachy dress up for Bloomberg, but he doesn't dress up for this?
Exactly.
What's all that about?
He suddenly found a tie.
Next time you're on this, Beach, I want to see you in a tie and a suit.
Last time I saw Chris Beecham was being bear hugged from Pete Ward in the quiz on Friday. So that is quite surprising. So, right, that's us then. That is, we've got a bone to pick with Mr. Beecham, but we are very happy to receive an upgrade here in Mini Cooper. How are you? How was your weekend?
It was good. Friday night, I went Oxford Street.
Shopping?
I went out to, it's like called The Market with my mates from school.
Right.
So I went out for dinner and had like an Indian there. Saturday.
Did you get ID'd?
Come on. Saturday, I did football. So I did the Arsenal-Everton game. So at Arsenal,
Producer Fred was there as well. Was it 0-0?
It was 0-0, yeah.
Well, that was an exciting game.
So at Arsenal, we have 6 seats, and normally what would happen is 2 for staff members and 4 for clients, and we get hospitality for every home game. So what we do is we take clients there, entertain them, we get a 3-course meal, and they really, really love it. We also have seats at Chelsea.
I can't wait to hear the but here.
But, Rich, have you been yet?
I have been to one game. Yeah, it was, I think it was a cup game last year, or against Bolton or something. It was 4-0 Arsenal anyway.
Okay. Maybe against Bolton then.
Yeah, that was it. Yeah.
So I did that, and then Sunday I just relaxed. I had to relax. I was knackered from the week, so I've got a busy week ahead as well.
So it was a good game. Everybody happy with the...
Yeah, and then I've got Arsenal Palace on Wednesday.
Well, I'm very happy to report you'll see my fantasy team here, Monkey Man. 61 points. Thank you very much, ladies and gentlemen. And not just 61 points, because he's got a 5-pointer on the bench to come in and replace Rashford as well. 66 points. What a team. Yeah, Young to come in. Even left 6 points in Newcastle's Burn on the bench as well. But, wow, what a team there. So, cracking. If my week goes as well as that, then I'll be very happy, because we got a lot coming up this week, don't we?
You're right.
Right, first of all, what we got coming up on the show? Well, we don't have a slide because producer Fred is too busy celebrating the appointment of François Bayrou. François Bayrou, the new French Prime Minister. Unfortunately, producer Fred did miss out on the role because he's not a deserter like Chris Beecham. So, yeah, coming up on today's show, though, we do have ESARS coming in to do confirm and send with me, because Mini Cooper does have to get back to work. And then we've got Pega coming up. We're looking a closer look at options today, and we are going to do a deep dive on Nike, climbing that hill.
Which we'll talk about today.
We're going to talk about that. Good stuff. And then we've got Axel coming in as well. So that would be Axel being around about 9:10 this morning, and go through all the technicals. So with that, shall we go to some overnight action?
Let's go.
Let's do it. Now, I made some new friends on Friday. We went for a client lunch.
Oh, yeah.
And I was obviously discussing the show, tell them the wonderful Luke Cooper was on Monday. So if there's any of the team there from our Friday lunch, we went for a great Italian, now what was the name of the place? Nah, pass.
What did you eat? Pasta, pizza?
It was a wonderful pasta, actually. Aubergine.
Aubergine.
Everyone else was going for lamb, and I thought, no,
Healthy option.
I'll save a little Silence of the Lambs, and I'll go for the aubergine. So it was beautiful. Then couple of drinks. Home by 5:30.
Oh, very good.
And the German girlfriend had her work party, so I had the whole evening to relax, watch Day of the Jackal. Very chilled Friday evening. So it was the happiest man. She got back about 3 o'clock in the morning. Oh, I was sound asleep. So yeah, that is a roundup of my weekend. Thanks for asking.
I did at the start. Brett, didn't I at the start?
Good stuff. But the best thing we've got, looking at the right camera this morning.
Right.
Big red light on there. I don't know what gives it away. So yeah, let's move on to what we're seeing. So we've got a lot going on, Mini Cooper. We've got a new French Prime Minister.
Yeah.
By this evening, then Olaf Scholz of Germany will have had no confidence voted upon him. So we'll get confirmation of a German election in February. So, does that mean Europe's getting itself sorted out?
Well, let's hope so.
Yeah. Really? I'm short euro. We're hoping so for the people's sake, of course. What's not quite got itself sorted out yet is China. We've seen the 30-year yield on Chinese bonds go sub 2% for the first time. That's because of underwhelming retail sales figure. So we saw the Hang Seng down 90 basis points, the CSI 300 down 0.5%. But yeah, real just, lackluster consumer demand there in China. That's why, of course, they're going to be focusing on driving consumer higher. The FT saying this morning that it's now about consumption over chips. They're more bothered about the consumer than they are about the chip sector. However, if you're long Broadcom, you're not going to be too bothered about consumption elsewhere.
Very happy for long Broadcom.
What a move on Friday. That was just staggering, wasn't it?
Yeah.
What do you think? The good numbers. They opened up 11% in the aftermarket on Thursday night. They were up 11%, and we saw them race higher. I mean, that chart just doesn't tell you the story. That tells you the 5-year gain on Broadcom. That's the weekly. Let's go to the daily.
Look at that chart.
And that's, we can see that the move is somewhere up here. So to show us that, we'll go to the 5-minute chart. And there we go. Absolutely staggering move. Going from 180 to 224. I couldn't help myself. Sitting at home, midday of the Jackal on Friday evening, I sold a strangle. So I'm now short the 250 calls and the 190 puts, because it's not going back down to 190, is it? I don't think so. Those were
unlikely.
Yeah, groundbreaking results. And what was interesting was money coming out of Nvidia on the back of it. So they found a new favorite stock, I think, by the looks of it.
Which I'm hoping we should make all sessions soon.
You've got a.
It should be soon.
Okay.
And you can trade it in the pre and the post market.
Brilliant. Okay, well, what we do have as all sessions is, of course, Nvidia, AMD. Look at that, down 2.5% Nvidia. And, Airbnb, I didn't see that down almost 5%.
Wow.
I'm getting killed in Uber. Uber down to $60. I'm short the 62.50s for this Friday coming. So that is...
You got Nike there as well.
Me a bit of pain. Yes. Now, why do you raise that one? What we got coming up in Nike Mini?
We've got earnings this week.
What night is that?
Nike hasn't had the best of years. Year to date, it's down 30%, whereas Adidas, year to date, is up just over 30%. So Adidas this year has done significantly better than Nike.
It's an incredible.
This will be the first results where we have got the new CEO, Elliot Hill, in management. So it'll be interesting to see what the report's going to be like. What do you think, Rich?
Well, just to sort of go over the significance of this guy. This is like Alex Ferguson returning to Man United. You know, this is like David Cameron returning to the Tory party. Not quite as popular. You know, this guy is Nike. He bleeds Nike. He is the swoosh. So I expect remarkable things.
He's worked there for tens of years.
Yeah, 25 years. He's been here about as long as some of the lifers out on the floor there. Who's the longest stand? Is it Chris de la Vega?
I believe DLV has been here for, I want to say 24 years. He's definitely the longest in the PCM team.
Elliot Harris.
Elliot's been here. Matt Arbor's been here a long time.
Arbor, yeah.
It must be one of those three.
Yeah. So you know, those kind of guys, you know, the experience they've got of the company. Elliot Hill is the same in Nike. So what are we expecting? Unfortunately, he can't work miracles.
No, of course not.
Right? It's like, you know, going back to your school exams. How did you get on in those A levels?
I did all right. Could have done better.
What was the real one that you could have done better in?
I messed up my economics. Well, I didn't mess it up. I did. Yeah. I should have done better because I've obviously got macro and you've got microeconomics. And
well, at least you know that much. That's a good start.
I have a huge preference for macroeconomics rather than micro. So I did this at AS as well. I did significantly more study for macro than micro, which is, I should have evened it out really. So then I did economics at uni as well. So then I like evened it out at uni, even though I still much prefer macroeconomics.
Well, so Elliot Hill, when the numbers hit the screen on Thursday night, right, they're going to look shocking.
Yeah.
But have you heard of kitchen sinking before? So throwing the kitchen sink at something.
You say it's going to be really, really, really bad, and then it's just bad. So
well, it's more like everything that's been done in the past is John Donahue's fault, right? So you've got this new CEO coming in. So what you do is you renovate the whole house, right? The whole house is just rotten from top to bottom. Mm. So you throw out everything, including the kitchen sink. The idea being that, you know, the kitchen sink is usually still all right. So that's what he's going to do on Thursday. So the numbers are going to be terrible. Mm. So, you know, I want a strategy where I think I might be short for the numbers, but then I've got an option position that is
long in the long term.
You know, a really, you know, looking for what you call climbing the hill.
Yeah.
Right. So I'm going to have exposure all the way up every single month. I'm going to have long positions that go higher and higher and higher.
Yeah.
Climbing the hill, Elliot Hill, name of the CEO.
I like that.
That's going to be my options position. Forget your iron condors and everything. This is just going to be climbing the hill.
Climbing the hill.
So
with Nike as well, they have a fair bit of exposure to China. Now, Nike lately in China haven't done that well. However, you could argue in the near future they could potentially do better due to the rise of the middle class there, okay, which would potentially increase the demand for Nike shoes.
And all this stimulus that's being thrown, at some point will be announced to be thrown at Nike. Yeah, so you've got everything coming together quite nicely. Mm. Expectations for 65 cents, right? So if you take that and just do a very simple, right, 4 times 65, let's see your maths.
280.
Ooh, close, 260.
Oh my God.
So 260. No, it was impressive.
No, it wasn't. That's very bad. Sorry.
260 multiplied. So that's our EPS estimates for the whole year. Put them on 25 times, you think? So 25 times 260, I think that's 65, $65. So I am very happy to sell a load of puts at $65 because I think this is as bad as it gets. And then use that income, that premium, to close my short position because I'll be short futures, short stock. and then also use the premium to buy upside. So that's the thinking on Nike for this week. Probably, it'll be the complete opposite that happens. But but generally, I'm thinking that the price will go in a swoosh.
With Nike this year, their classic shoes, Air Force One, they reduced the production in March 24.
They're terrible.
Which is
the quality is absolutely shocking.
I do love the Air Force One though. It's like one of my favourite shoes.
Oh yeah, the traditional model that from 10 years ago when they used proper materials. But if you hold an Air Force One in one hand and a New Balance shoe in the other,
they're becoming a lot more popular.
Yeah,
I've seen you rocking a pair of New Balances, right? There we go.
Guilty. But my demand is still there for Nikes. I really want to buy a good pair, but I can't. Oh, I'm more talking about the shoes rather than the stock there, Terence. Sorry, Terence is on fire this morning. He's getting, as soon as I said Nike, he's like, chart up. But yeah, it's actually it's a pair of shoes that I want more than the stock. But so that'll be Nike. That'll be really interesting. What else have we got this week then?
This week we've got FedEx. FedEx, got some figures on FedEx.
Think they're going to deliver?
We'll see. So Wall Street expects a year-over-year decline in revenue for the quarter ending November 24. Revenue for the quarter, so Q2 2025, is projected to be $22.12 billion. Okay. In FY25 Q1, analysts did project revenue as $21.9 billion. However, the results were only $21.6 billion, so $0.3 billion short. Share price was down 15% on the day, and the weaker performance was due to the customers shifting away from paying higher fees for priority shopping.
Right.
Which makes sense due to cost of living crisis. Customers are less willing to pay for that faster service, hence why FedEx has struggled, which is what their CEO said. On the last
I haven't looked at this one for a while, actually. It's kind of done a whole load of nothing. I remember UPS had a shocker because I tried to trade UPS and I've never lost so much money so quickly. I think I was down $400 in about 3 minutes.
Wow.
Trying to catch the knife on UPS. And FedEx was far superior, but they've just done nothing since then. They're stuck at that 280 level.
Last year, they announced a big cost reduction. Numbers are to deliver £4 billion of permanent cost reductions in FY25.
Yeah.
And also in September 2024, FedEx announced that they invested in an AI robotics company to help streamline operations. So it seems like everyone's getting involved in AI.
Well, some people wish that AMD didn't, because we're getting asked on the chat there, when is AMD going to bottom? That is a sorry looking chart for one that had so much promise. That really is it. It peaked out at 210. Now, I'm pretty sure this was when we had the presentation from Jensen Huang about how good NVIDIA was.
Right.
And AMD stock started dropping, and it was just the most obvious long NVIDIA, short AMD ever, because he was destroying them and they had absolutely no hope. And I think that was around about March or April time. It was like the not Investor Day, but it was Jensen presenting to the world, and it just has never recovered since. And when is it going to bottom there? That is,
I mean, you can
people just dumping AMD in favor of Broadcom, isn't it?
Yeah.
Okay, good stuff. Right. Okay, so we've been through Chinese retail sales. We've been through the new French Prime Minister. We've been through Chris Beecham. Traitor. And we've been through Olaf Scholz. So what do we have left? Well, we've got Paddington is coming to London. The FTSE is going French for a day. What on earth am I talking about?
I'll be honest.
Canal Plus
Canal Plus
is the biggest FTSE IPO today, this very day, in 2 years. So Canal Plus, of course, the Vivendi spin out. Vivendi thought, right, we're worth 10 billion euros as a conglomerate, or the sum of the parts is worth far, far higher. So let's just split ourselves up. So Canal Plus, very interesting, is it's just done a deal with MultiChoice. Now, this was, when I lived down in Johannesburg, 2013, this was my TV provider.
Oh, okay.
MultiChoice is the big kind of African and South African TV network.
Yep.
I guess pay-per-view, you know, like a Sky Sports kind of thing. So Canal Plus are in the process of buying that at the moment, which will make this subscription company big. And 2/3 of their subscriptions are outside France now.
Oh, okay.
So they thought, right, we'll go and list on London. We'll go and find some value. So that's the excitement of today. And you might, have you, Amy Winehouse, Back to Black, have you watched that?
Yeah, I've heard of Amy.
That's Canal Plus.
Oh, okay.
And then, yeah,
What's the pronunciation? Canal Plus.
So it's like it's a plus sign, but they think they're still French. So Canal Plus.
Canal Plus.
Oh, producer Fred is dying in there. Right, so we've got that today. Anyway, so their big growth markets are in Africa, Eastern Europe, the Middle East, and we've got that coming. So an IPO. Have you seen many IPOs on the FTSE?
Not too many. I mean, recently we have seen more companies. I think we're going to see this in the near future, that more companies are actually going to list in the US.
Yeah.
Rather than the UK.
Well, that's it. And this, so this is ahead of Shein next year. This is the most exciting moment for you to see a new company.
Another thing with IPOs, I learned this from an article which I read on the IG website, where we really see them go like one way or the other within like the first 3 months of actually trading or investing in. So I would argue that trading or investing even in an IPO, which is considered safer than trading, that is potentially quite risky.
Right. Yeah. Excellent. What is not excellent is a Guinness shortage. Big panic around the pubs over the weekend. Guinness crisis, people are calling it. Yeah.
I'm not a fan of Guinness, I'll be honest.
Right. Well, I mean, that could save us.
That could save us.
Get into the pub and don't order Guinness. Pubs running out of Guinness because it's so popular. We've got the incredible social media page called Schooner's Social. No, Schooner Scorer. And he's going around finding the best Guinness in the world, mainly in London. And he's got to try and get this splitting the G.
And has he found the place yet, or does he have to visit so many pubs?
It's the Devonshire.
Oh, okay.
Just off Piccadilly. Yeah. And I must admit, you rock in there. I'll get the picture up. You go in there and they're pouring. It must be 6 pints a minute.
6 pints a minute?
6 pints a minute.
Wow.
It's absolutely incredible. So, right, good stuff. Right, Mini Cooper, it is now 7 minutes to 8. We'll take a really quick 3-minute break and we'll be back with you for the opening bell. Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome back, everybody. Mini Cooper, we got some upgrades and downgrades for you here. You ready?
Let's go.
Let's go. Right, so Glencore raised to outperform BMO.
Okay, interesting.
BMO, not quite JP Morgan, but BMO. Rio Tinto, the Daily Telegraph's looking at investigating, how good that stock is. They come up with the idea to buy. That's just reminding me, there's a great piece in the FT today, and it is how the mother of all bubbles will pop. Let's take a look at that one. Where can you find that one on the FT? How the mother of all bubbles will pop. It's talking about the S&P 500. It's talking about the NASDAQ.
But when?
And it goes into, well, they're saying not imminently, but within, certainly to look at have a look in it happening in 2025. Virtually every Wall Street analyst predicts US stocks will continue outperform the rest of the world. All this enthusiasm only tends to confirm that the bubble is at a very advanced stage. Really interesting article, worth writing. It, of course, goes into the huge debt problems that America is facing at the moment that nobody talks about. Everybody just sweeps under the carpet. It takes $2 of debt to gain $1 of GDP growth. So, that square doesn't circle.
It's interesting with the US at the moment because we've got equities at an all-time high, crypto all-time high, and house prices in the US at an all-time high.
Oh, house prices at all-time high as well?
Yeah.
Interesting. Right, we've got 60 seconds to go to the bell. So any more? We had Porsche. VW. Porsche Holdings warns of up to a 20 billion impairment on their Volkswagen stake. So doesn't sound great, but I guess just a mark to market. So that could well have been known. But your upgrades and downgrades brought to you, as always, by John McGuinness from our Dubai office partner.
Thank you, John.
John helps us out. Not too many upgrades and downgrades there. Capri is up on a report that it's looking to the sale of Versace and Jimmy Choo. Right, pick up your bell, Mini Cooper. You're ready to go. We're going to count you in. 3, 2, 1. Ring that thing. That's the most interesting bell ringing that I have ever seen. Right, I'm not sure if you're getting an A level for ringing that bell.
GCSE?
GCSE, well, we might send you to Notre Dame. Get that reference?
Yep.
Right, where are we then? We're off and running on this Monday morning. It is Monday, the 16th of December. It's the last big week of the trading year. You've got that Fed interest rate decision. You have got big Nike results. You've got a quadruple witching on Friday. So this really is, if you want to do something big, if you're looking for liquidity, this is the week to do it.
Yep.
Now, WH Smith up 2% there for Expo, also up 2%. Do we have any big names there? Not really much of a muchness there. What about on the downside? Oof, Entain. Why is Entain getting carted?
It's down 4.75%.
Wow, right. Adidas also down 1.2.
Oh.
Is it time for a long Nike, short Adidas? Oh, that's a tricky one, isn't it?
So, no.
I mean, not by the looks of the Adidas store in where the shopping centre that I was in on
Which
Saturday.
shopping centre was this?
Westfield. Over in Shebu, or Shepherd's Bush, as some know it. Right, what else have we got? We got Carnival down 1 point. That looks like a spurious one. Persimmon. There was some negative stories around in Persimmon this morning in the Times. Quickly show you that one. Persimmon hit by 40 million in extra costs. So that's just the CEO talking about the cost of the tax rises there as per usual. Entain has been sued by the Australian financial watchdog. That is where you're getting your down 4% from. So that's an interesting one. Let's see if that's on the news section yet. Wow, so they are being accused, quite an accusation there, that Australia launching legal action for breaches of anti-money laundering and counter-terrorism financing laws. So, yeah, Australia going to town on Entain there. And, yeah, you're looking down 4% on that one. That's, talk about a black swan. I did not get any hear of anything like that being talked about. Right, what's going up in Europe? Is there any benefits from the new French Prime Minister? Doesn't look like it. We've got Rheinmetall up 1.6. Puma up 40 basis points, but nothing really motoring away this morning, is there? Bars Iron Brew up 1.2. Glencore, there it is. We've got a little bit of positivity around. That's from the BMO upgrade. 373. Wow, that really got killed.
And you've got Direct Line Insurance Group up 0.57% there as well.
That's probably just the time value of the weekend, isn't it? Because, of course, Direct Line has sold itself.
Yep. To Aviva.
And, yeah, we're looking at, 248. So the final price, 275, including the dividend. So, yeah, that as we get closer to the deal being completed, then Direct Line will continue to edge higher and higher and higher. Just the chance that the regulator steps in as well at some point.
Yeah.
Right, Barclays up 60 basis points, AstraZeneca up 55. So where does this leave us for the FTSE as a whole? I hear you ask Luke Cooper.
Let's have a look.
Right, big moves of the day. Oh, look at that, S&P 500 up, James Bond. And we've got the NASDAQ closely aligning to it. Gold, not much change, but it has sold off again from that 2,700 level. Oil, bit dull, stuck around that $70. Copper cannot sustain a rally. Has dropped from 432 down to 420 since Wednesday. But interesting, we've seen a bit of vol come in.
Yeah,
That
just
is
under
interesting.
1% at the moment.
Yeah, now that's been as low as 15.7. So the VIX starting to pick up there. It is a big week. We've got quadruple witching. We've got the Federal Reserve. We saw the stock favorites of Nvidia, AMD. Them sell off on Friday because all the money was flown into Broadcom. So maybe. Of course, Broadcom hardly has any effect on the big indices, whereas the others do.
Could you say that because on the 23rd of DEC, Palantir and MicroStrategy are going into the NASDAQ, which therefore means that ETF and mutual funds would have to buy into it?
So that's very, very much worth noting as well. Just go over that again, Mini Cooper. For anybody, tell us what is going in to the NASDAQ 100.
So on 23rd of December, Palantir and MicroStrategy are both going into the NASDAQ, which means that ETFs and mutual funds which track the NASDAQ would therefore have to buy both Palantir and MicroStrategy. I mean, Palantir was in huge growth. It joined the S&P in September time. It's now one of our most popular traded stocks. It must be around 6th or 7th at the moment, because on the equities list on our platform, you can see as the usual filter is by the most popular.
This is just incredible, isn't it? I mean, we'll have a look at this at 9 a.m. But of course, with Bitcoin being up 2% over the weekend, or 3% over the weekend.
It's like 103,000 USD now, Bitcoin.
Yeah, so you would imagine MicroStrategy might receive some benefit there this morning as well. Andrew McKelvey pointing out Entain announced the investigation 2 years ago, and now Australia, this is of course involving Entain and those money laundering allegations, Australia now prosecuting the company. So you've got Entain down 4% on the back of that this morning. So we take a quick look at FX and commodities, Padwan.
Have a look.
Here we go then. Right. So there is our currencies of the morning.
Now we've got cable there up 0.13%. This week we have Fed and Bank of England. Now it's a 96% chance that the Fed are going to cut rates by 25 basis points.
Yeah, that's pretty much a done deal, isn't it?
To 4.5% from 4.75%. And here in the UK, rates are projected to stay the same at 4.75%, so no movement there.
It's quite incredible, isn't it? I wonder if those GDP figures rocked the confidence on Friday in the UK, and some members of that Bank of England. I'll be interested to see what the shadow committee do the day before, because of course there's always a Bank of England shadow committee put forward their recommendation, which you get on the press on Thursday morning, or is it on Wednesday? I think it's Thursday. And yeah, we've got a big few days. You've obviously got Bank of Japan.
Yeah.
You got the Fed cutting by 25 basis points. But what will that the SERP show? What will the projections show?
They're saying in January that they don't expect the Fed to cut rates. Now, we've got Trump coming in on Jan the 20th, which is when these tariffs are going to be enforced, which are arguably very, very inflationary. Mm-hmm. So you could say that in 2025 that we may not potentially see these huge rate cuts because of these inflationary policies.
Yeah, it's a big one to watch. Isa and I are going to be talking about that more in about 10 minutes' time. So join us for the Confirm and Send today, which will have a tilt towards central bank policies. Right, where's my commodity page gone? Where has that disappeared to over the weekend? What have you done with it? Let's go to this backup page instead. So
not in the red there.
Yeah, natural gas down 3, carbon down 1, and yeah, gold
and silver up.
Yeah, palladium small down. God, palladium getting hurt in that one. Oh, Mini Cooper, what do I do with palladium? It's in the pension, so it is a long-term position, but it's very disappointing. Is 2025 going to be the year of palladium and platinum? I think we've been saying that every year. And then, oh my goodness, still going is coffee and chocolate.
Yeah.
When people say invest in the things you love, I mean, you know, this could have been the way forward. So let's have a look at Arabica. How's that? Look at that.
Yeah. I remember seeing in the news around Easter time how much the price of Easter eggs have gone up because, of course, the price of cocoa shot up due to a fall in supply and increase in demand.
Yeah, and look since, so that must have been, when was Easter this year? Mid-April.
April.
So that was the first spike in April that got. Sorry, I'm looking at cocoa. I'm looking at coffee. Getting coffees for Easter. So let's have a look at cocoa in London as well. Yeah, there we go. There was your spike. So it did come right off again, but it's going back in. I guess people buying their advent calendars.
Also with cocoa, you've got to remember you have got the growing middle class in China, India. Now, when they have more disposable income, they spend more money on chocolate, which you could argue is, it's not a necessity, it's more a luxury good, which would increase the price. And if supply doesn't increase due to, cocoa
I think it's the supply is the issue.
Yeah.
Supply has been hit, all the weather systems.
And in addition to that, I know the EU basically wanted to enforce higher wages and standards on the workers in Africa. Now, of course, that comes at a higher cost as well.
Yeah.
So that's another factor.
Good. Right, shall we say hello to a few people then, Luke Cooper?
Let's go.
Who have we got? Go on, you kick it off.
We have got Carl Wolf. Good morning, Ange. And we've got Gavin. Good morning, Ange, again.
Well, no, you can say good morning to them if you like.
Good morning, Carl. Good morning, Gavin.
You'll see Ange enough, but I can already hear her popping into the studio in the background. Darwin, good morning now, Darwin. I don't remember seeing a comment from you before, so do tell us who you are, where,
and what do you trade,
and what do you trade? Where do you come from? Where do you go? Well, speaking of that, you seen Fred's shirt this morning? He looks a bit like Cotton Eye Joe. Where do we come from? Where do we go?
Fred's got a matching outfit today. I noticed you've got a grey top and grey shoes, so I'm very proud of him.
Is that right?
Yeah.
Look at that. R6N, very good morning to you. William, good morning to you as well. Oh dear. Darwin, of course, comes from apes. Very clever. Here we go. We're starting the week like this, and that's how we mean to go on. Do we have any other apes in the chat? So yeah, Julian with us this morning. Good morning, Julian. Good morning, Ben. Aha, Ben is back. Now, Ben's been busy because he has been building his retail empire. This lad made a load of money in Upstart, trading on the IG platform, took his profits and bought a sports store, a sports retailer called Sterling Sports in Queenstown. So it opened last week. Ben, let us know how it's going.
Congratulations.
Congratulations indeed. He's been sending me pictures. So that's great to see. And then also his favourite stock, Upstart, got an upgrade, I see. I think it was Gavin that mentioned that one. So oh my goodness me. No wonder he's been buying a sports shop. Look at this. He'll be wishing that he had kept the money in there. So yeah, Ben was building a position in the mid 70s. Oh my goodness, what a chart. Oh dear. Have I bought any of these throughout the last 6 months, as he's been telling me? Not a single share. Not a single one.
Big mistake.
Oh dear, that's why I don't have a sports shop.
One thing I wanted to say quickly is for those clients who invest, always make use of your ISA allowance, which is £20,000 a year. So here we have ISA and share dealing. And one thing about our ISA offering, which separates it from a lot of our competitors, is that our ISAs are actually flexible.
Excellent.
I wanted to say that.
Nice little sales pitch.
A lot of clients don't actually know that, and a lot of advisors elsewhere aren't flexible.
Yeah.
So it's really important that clients do know this, and they can therefore withdraw larger sums, larger than £20,000, and put them back in the same tax year, and not lose out from it.
See, this is why he gets the top marks on his review. Not like that Chris Beecham. Eh?
I hope Pete's listened to this.
Punch, a very good morning to you, Punch. And JG now, does that stand for who I think it does? JG, a very good morning to you. Seeing that name on the chat for the first time as well. So with that, we've got Isar waiting in the wings for a bit of confirm and send. We're going to talk about the Fed. We're going to talk about the central bank policy. Join us again in 5.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
I'm Ben Hemmington, and I head up the sustainability function here at IG Group. IG Group pledges 1% of its annual profits and directs this to community initiatives. This is a pretty significant amount of money. We're talking several million each year. And I used to work in the charity sector, so I have first-hand experience of just how much of an impact this money can actually have if it's used wisely. In particular, we are focusing on empowerment through education. So looking to see how we can empower members of our community that are disadvantaged in different ways by providing access to quality education. It's an area of work that we're really proud of and that we're having a really excellent impact in. On the IG Group website, we have a download centre which has got lots of information about our sustainability function. Here you can find out more about our product governance, about responsible investment. We have documents around our diversity and inclusion, including a D&I statement, KPIs and targets, as well as our progress against these. You can also find a number of documents relating to how we manage our environmental impact. And then also on that download centre, you can find our community impact report that talks all about our Brighter Future Fund and the impact that it's having.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
To find a list of all your open trades, click on Positions in the sidebar menu on the left. Here, you'll be able to see key information about each of your trades, including the market name, the size of your position, the opening price, the stop order you chose, and your limit order. You'll also be able to see your profit and loss. Positions are normally sorted in descending order of your latest trades. To change how your positions are listed, you can filter your view by clicking on your preferred factor, like which trades are making you the most money, by selecting profit and loss. You can edit your limit order or stop order by clicking on the figure and entering your desired number. Lastly, you can close your open trades by clicking on the Close button next to the relevant trade.
I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's the show where we look at everything technical analysis, hoping to help you upskill Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Good morning, good morning. Welcome back. So we've done opening bell. Now we're going on to confirm and send with the wonderful Isar. Good morning, sir. Welcome back to the studio.
Thank you very much. I was virtual last time, so I
That's
haven't
right.
seen, you guys can't see at home, but we have these new screens set up, which are all very fancy.
Which is great, which is why you'll see my eyes go down here sometimes. But it's better than going down here, where they were before. So yeah, big shake up. More to come.
Yeah, exciting.
We might
times.
even be able to get a lick of paint soon.
No way. Well, they can't see, but the whole background is green normally. And so you can't wear any green. I shouldn't reveal too much from behind the curtain.
Well, to be fair, so for the quiz that we filmed on Wednesday, I had a green Christmas top. And which, it looked like Jason in his Technicolor dream coat, that disappeared.
I have a Christmas jumper which has red candles and green candles.
Why aren't you wearing it? I actually looked up on Amazon.
The green will blend in with the background.
Yeah, of course.
Yeah.
I did look up on Amazon. If you want to get a real stock geek jumper, have a look on Amazon. You can get a bull and a bear, or you can get a Christmas jumper, which is the candles.
Yeah, and I was wearing the candles one, and then I met Angie in the corridor, and she was looking at it, immediately started doing technical analysis on my jumper. It's very funny.
Which I have to get Axel that for his Christmas.
Yeah, exactly.
Because Chris Beecham's off the Christmas list.
Oh, really?
So yeah, we'll get Axel a Christmas present. Excellent. Right, shall we go on to our first question then, Isar?
Yes. Can we expect a surprise move from the Bank of England given the recent economic data?
A surprise move, obviously, being a cut rather than staying as they are.
The consensus is that the Bank of England will pause this round and then cut in later rounds. The revision to GDP data took us from 0.1 expectations to minus 0.1. So that is actually quite a significant change. And so I guess the question is alluding to the fact that if the economy is a bit weaker than we think, do we think they'll cut more aggressively? So my guess is no. The Bank of England, unlike the Fed, has a single mandate and not a dual mandate. Yeah. And so they are just laser focused on inflation. It's really worth, if you want to get inside the Bank of England's head, every quarter they release what used to be called the inflation report and is now called the monetary policy report. And the November one really talks about how they have a general confidence that inflation is kind of coming back on track. But they have, especially with it being in the region of 2% now, but they see some areas where upside risk might be emerging.
Yeah, different scenarios, don't they?
Yeah, which is really interesting. So they have a whole box that goes through 3 big scenarios that could lead to inflation upside. And so while that is still an uncertainty, I think they're going to be pretty focused on going quite gradually through their rate cuts.
Is that a problem? Obviously, US has a dual mandate.
Yeah.
And little bits and pieces alongside it as well. Sort of price stability includes market stability.
Yeah,
it seems like.
So the Bank of England has a dual mandate, but the dual mandate is about inflation, where monetary policy is the lever, and then the second mandate is all about financial stability, and that has a totally separate infrastructure. So instead of the Monetary Policy Committee, you have the Financial Stability Committee, and then a whole different set of policy tools they look at around liquidity supply. And so whilst they do have two mandates, it's much less closely entwined than the Fed.
Yeah.
And the second thing that's really interesting is the Bank of England has its inflation mandate is 2% plus or minus 1% in the medium term. And so they have a little bit of breathing space in how they think about inflation, and they think about transitionary shocks, or famous transitory phenomenon.
Yeah.
I think the Fed often
Which
gets in
actually,
trouble in.
he wasn't too far off.
It wasn't too
It
far
was
off.
just the question was, you know, how long is transitory?
Yeah, and the magnitude was, I think, higher than they would like.
And I think he really does actually want to turn around and say, told you so.
We got it right. Yeah,
Yeah.
exactly. But I think, yeah, so the Bank of England has a bit more breathing space, also because they very intentionally never defined what medium term is. And so they can then think, I think, they tend to think on a kind of 2 to 3 year time horizon, which is, do we tend to see inflation coming back to target over that?
And which is, I think it's 2027 that they have it coming back to target. isn't it?
Yeah, exactly. So if you actually look, the Bank of England actually has a really bad track record of forecasting. And actually, I can send you a chart, maybe offline, from, I think it must have been a year and a half ago, that Ed Conway, who's the economics editor at Sky, made, where basically you see every single projection they made at the time just has inflation gently falling back to target, even though inflation was rocketing up. And on the way up, it looks really embarrassing for them. And so they had a huge problem with forecasting. They actually recently did a big review into forecasting with Ben Bernanke, who basically told them a bunch of the way that they forecast is bad.
Wow.
And so now they're doing this big project within the Bank of England to try and change how they do forecasting. But in the meanwhile, they are projecting that by late 2026, early 2027, inflation will be kind of back on and stably on the 2%.
Now, if you want a great summary, Sunday Times, this is how I spent my morning yesterday, drinking a coffee and going through David Smith's piece in the Sunday Times. So there is the, everything we're talking about there. Waiting to see the full effects of the budget. And that's, there's going to be big changes over the next few months, but really worth having a read of that one.
Yeah, it's great. I think we in the UK struggle to have Fed whisperers in the same way that the US does.
Yeah.
And I think David Smith is one of the best actually at providing quite a good insight to how the bank thinks. And then I think we also have like a slightly different decision-making structure because you have internal and external MPC members. So I think what I tend to do is I try and read all the reports, which, as boring as it is bedtime reading, gives you a really good insight into how they're going to make decisions.
Yeah. So having done that, what's your best guess, and how does cable react in both scenarios?
Yeah, so I think they're gonna pause. I think actually now that's pretty consensus, but there was a period of time where the market had a bit of a wobble thinking they might cut. I think if they pause, it's going to be kind of a non-event, I think, in my view. I think it'll depend a little bit on what the Fed does and what BOJ does, because this is, I think, like you might have mentioned, this is like the central bank week. This is the week where all the action happens before Christmas. And so, yeah, I think it's going to be a bit of a non-event. What I would say is I would be really interested at looking at the Fed quarterly monetary policy update, because in the November quarterly monetary policy update, their projections for GDP in 2025 are actually quite bullish. And having seen the downward revision now, it will be interesting to see if they kind of revise that forecast or if they just assume that 2025 is going to be quite positive for growth.
Yeah.
So the OBR, who do their own GDP forecasts, are basically assuming we're going to grow roughly at 1.5% for the next kind of 2 years or so. But the Bank of England is projecting that we're going to grow 1.7% next year.
And Goldman's on Friday, Goldman's went to 1%.
Yeah, exactly. So you might see that 1.7 revised downward, which would have an impact on unemployment, which in turn impacts inflation. But I think, I guess it's a bit yet to be seen. I think they're waiting for the data. I do think Bailey I think the bank in general is quite a conservative decision-making body, and they're much less likely to scare institutions, especially post Liz Truss, than you're likely to see from either the BOJ or the Fed or anyone else.
Okay. Excellent. Right, that's Bank of England. On to question 2, please. What does an increase in government spending mean as far as BOE? So we'll be quick on this one because we've got the Fed to get onto, of course, as well. But yeah, government spending.
Yeah.
I just put up the cable price there as well. As we've seen, this is only a 1-month chart.
The further back you go, the more it just looks like exactly the same picture, but more extreme.
Yeah,
it is. I think it's tough. I think we're basically seeing government spending in the short term increase, but actually the longer term fiscal horizon is going to be quite tight. And Rachel Reeves seemed to be suggesting that when they do the spending review, which is going to be the budget plans from now till the end of the parliament, they're going to have quite a tight envelope for the last 3 or 4 years. And so then government departments will be asked to basically try to make efficiency savings to pay for all of the fun extra stuff they can do.
If only they had Elon.
Well, yeah.
He could save the world, not just
Well, but
America.
they did. Someone inside the government said that Dominic Cummings was right, and that was like their big kind of insight from the first couple of months in power, which is kind of an absolutely insane thing for the Labour Party to say. But I think there definitely is need of reform in some of these government departments. And actually the big story of all the budget news is that health is just eating everything. So the expected spend overall is going to increase, but the share of that that's going to the NHS is getting bigger and bigger and bigger. And I think I saw a funny forecast, which was something like by 2060, all of government spending will just be the NHS.
Wow.
So I think there's definitely need of reform, and I think it's hard for the bank to make any kind of big assumptions longer term. I think the big updates to government spending will not happen now. They'll happen when the spending review is done next year.
Okay.
Yeah.
Okay. Right, good stuff. Okay, on to next question, please. Yeah, here we go now. What role will US fiscal policy play in shaping Fed monetary policy?
I think this is a great question because I think it speaks to the complexity of the Trump-Powell dynamics, because he obviously originally selected Powell and nominated Powell, but now it doesn't seem like he's the biggest fan. And Powell basically was asked at a press conference, I think in the last cycle, like, would you tender your resignation? And he said absolutely not. And Trump doesn't have the power to immediately fire him. So I think there's some tension potentially.
Yeah. And now Trump has said, I'm not going to ask him to go. I'm not.
Yeah, exactly.
I'm not going to ask him. And, he has said that he wouldn't go if I asked him. But if I told him,
told him to
go, he would go. I mean, it's such a joke.
Yeah, it's funny. And I think the Fed is in a slightly sticky situation because if there are large cuts to government spending from Doge and Elon, I think that will be a downward pressure on GDP. And so then there might be an expectation they'll cut more. But at the same time, you're kind of seeing slight resurgence in inflation. You're seeing unemployment pretty stable, actually, like gets slightly worse, but remarkably stable, all things considered.
Or questionably?
Well,
is it real?
I have some questions about the jobs data. I tend to wait for the QCEW, which is the quarterly update of the jobs revisions data based on actual payroll data, as opposed to surveys, which is the way the BLS normally releases data. And we saw in the last QCEW, the actual number of people employed was about 1 million less than expected, which is a massive revision, the largest downward revision on record.
Right.
And part of the reason for that is because the way the Fed and the BLS actually think about unemployment is they take the survey data and they don't just give you the survey data raw, they add assumptions on top of it. And one of the major assumptions they add is something around what's called the birth-death model, which is the number of new businesses they expect has been opened and the number of old businesses they expect have been closed. And the reason they have to do that adjustment is because if you're shutting down a business, you're probably not going to answer a survey from someone phoning you from the Fed. If you're starting a new business, you're probably also not going to answer the survey from the Fed. And so then they have to do these adjustments. And I think actually because of COVID and because of changes in the general life cycle of businesses, that data has been way out what it's been historically. And so that's kind of led to a rosier job picture than actually what happens after you see all the revisions.
Which, I mean, it does look, I saw one fact that the people responding to the survey has just dropped and dropped and dropped. It's only 40% now.
Yeah, but they still phone people up. Like, would you pick up the phone to someone random who sounds like they're from the Fed and calling you? I think I would just assume it was a scam.
Yeah.
And yeah, I think the fact that they're still so phone oriented has led to the data quality being much, much worse than it used to be. And that's the household survey. They also do a business survey where they phone up businesses. But likewise, like, I don't know if you're a CFO, how likely are you to pick up the phone and talk to the Fed about the number of people you employ?
So I'm sure Elon will fix that.
Yeah, I think the data quality is a real issue, actually.
Yeah.
And yeah, I think they should be looking at it. I don't know. I don't think Doge. I don't think it's top on the Doge hit list of things to look at.
But it could be our answer why they're cutting rates when it seems that there's absolutely no apparent need to do so.
But Powell has spoken about how he's had to look at the job revisions and keep those in mind. And it's why they actually look quite closely at the qualitative data, things like the Beige Book, which have been a bit less rosy and shown a bit more hesitancy, especially from small and medium-sized businesses.
But it's not showing up in profit margins at all. And it's not showing up.
No, and the consumer is strong, actually, and we are continuing to see the consumer continue to buy. And
is that consumer confidence or is it consumer wallets?
Well, I think it's definitely a confidence thing, especially post-Trump. I think there's definitely a lot of bullish sentiment around, but generally, actually, you've seen consumers buy. I think if you look at the savings rate, you've actually seen that tick lower and lower and lower since we had those massive savings gluts during COVID where you couldn't go out and everyone got their stimulus checks. Now you've seen that really run down almost to pre-pandemic, but not quite pre-pandemic levels. So I think that is a bit of a concern. There's a question about how long that can go for. But really, like, I think the question for the Fed is not about whether they cut or not. The question is, how many cuts do we think they do in total, and how hawkish or dovish is the language the Fed uses?
And of course, this is our favorite good old Fed Watch tool, which of course, there's no point looking at the chance of going to 4.25 to 4.5. That is done. Then 81% chance of staying there in January. And then March is more of where we've got the currently 54% chance that we go for another 25 basis points.
So I think the thing to look at is actually click December of 2025.
December 2025, there we go.
And then click on the left side of the page, click compare. It says current, just on the top left. If you go and click compare, you can see how these probabilities have actually changed over time. And you can actually see that they're basically skewing more towards 3 cuts rather than 4, which is really interesting. And actually, if you look only a month ago, there was still a pretty solid expectation that there would be 4 cuts. And I think this is speaking to the phenomenon where last time they cut, you actually saw the long yields go up and the shorter end of the yield curve go down. And so you saw this kind of bearish steepening. And there's a good chance we might see the same.
Just run people through why it's called a bearish steepening.
Sure. It's called a bearish. So a steepening is where the yield curve kind of gets more extreme, where the short end of the yield curve is kind of more inverted relative to the long end of the yield curve. So it looks like a little bit like this. Yeah, exactly. Yeah. And it's a bearish steepening when that gets more extreme. And the reason it's bearish is because most companies and most people who are borrowing actually in the long end of the yield curve, not on the short end of the yield curve. And it's bearish because it kind of implies rates in the long term are going to be higher than we expect them to be, but they're cutting now. And so then there's the kind of implication that either relative rate cuts that were expected are not going to materialize, or even rate hikes are going to come. In this cycle, we're not talking about rate hikes. We're talking about cuts that were previously priced in, no longer being priced in. So that's kind of what happened in the last cut. And I think there's a chance we might see the same thing in this cut, depending on the kind of language around how hawkish the Fed is and how the market actually responds. And so what you tend to see is for the kind of couple of weeks after the Fed meeting, everything moves in tandem, and then actually actually the market kind of decides how to respond to it. And that tends to happen in the 5 to 10 year yields rather than the kind of like the bills up to the 2-year yields, which tend to be much more of a just pure predictor of what we think rates are going to do in the next 2 years.
All right, here we go. Here's our treasury yields across the board. So you can see 10-year currently at 4.38 and the 2-year 4.23.
Yeah.
And we've got that 20-year out at 4.67.
So we actually just had the, I think it's the 10-month, 3-year uninversion. So like famously, an inverted yield curve tends to be a predictor of a recession because it kind of implies that in the long term, you're going to get rate cuts, which only really happens when you have kind of periods of difficulty. And if you actually look, the thing that's really interesting to me is yields right now, 4.3%, and that's kind of flat essentially until the 6-month time horizon.
Yeah.
And you see the 1-year, 2-year, and 3-year are actually lower. And so they still are like a little bit they're a little bit inverted. And then back out by the 10-year, you're looking at 4.4% almost again. And so that's because the further out you go, the more risk premium you take on. I think that takes into account things like the fact that the US government debt levels are quite high. And
Quite high.
well, they're high. They're very high. Well, we're about to talk about the BOJ, so it's all relative, isn't it?
Yeah, they're very true, very true.
But they're high, and so markets do have a couple of worries about that. So I guess I think this is a Fed where we know what the decision will probably be. It's just a watch for what the language is, and it's a watch around what the SEP is, because it's also an SEP-based Fed.
Yeah.
So we'll see their projections, and like we spoke about, I think last week, the thing that I am looking for is what they think the long-term interest rate is going to be.
Right, here we've got the projections. So this is from September, and let me just go into the median so everybody
I think the
can
median
see
is the
what we're
one that
talking
I
about
think
there.
you probably want to have a look at. So the thing that I am really, really interested in is this final column, which is what do they think the long-run federal funds rate is going to be. So it's been ticking up. So in June, they thought it would be 2.8%. 2.8% is actually above historical. Historical, what they assume is that what they call the natural rate, the real natural rate, is 0.5%. And if you expect inflation to be about 2%, that implies a federal fund rate of 2.5%. But they are currently projecting that the long-run federal funds rate is going to be higher than what they normally think the natural rate is. The natural rate, by the way, we should do a whole episode on it. It's basically this weird faith-based religious thing that central bankers believe in or don't believe in. But anyway, this is the rate that they think is neither restrictive nor easing. It's kind of neither loose nor tight. So they used to think that was 2.5%. Then they thought it was 2.8%. In the last cycle, they thought it was 2.9%.
Yeah.
I wonder whether that hits 3%, which is actually quite a big moment. And if it does hit 3%, it implies that rates right now are not as restrictive as we might have previously thought they would be. They still are net restrictive, and so we still should expect the Fed to cut, but we might expect them to cut a little bit less in total because they think the long term should be a bit higher.
And remembering that these numbers have to go into equity models across the board.
For sure, and that's how you do discounted cash flow models, and like I think markets right now are a little bit disconnected from valuations. but if you move to a world which is more valuation driven, these kind of changes are actually pretty seismic, because 0.1% doesn't sound like very much, but when you're compounding it not over 1 or 2 or 3 years, but you're compounding it over the lifetime of an asset, it actually does really add up.
Yeah. And we just got a quick question there. So Andrew McKelvey asking, could ESAR please explain what a normal curve should look like when not in recession?
Sure.
So maybe I go back to the bond, give example numbers, I guess. Of
Sure. So I think
that would look.
So I think the numbers themselves don't matter so much, but what you would expect
the spreads,
is, what would you would normally expect is that the rate that you borrow at on a 2-year time horizon should be lower than the rate that you borrow at on a 10-year time horizon. And the reason for that is because borrowing on a 10-year time horizon is just riskier than borrowing on a 2-year time horizon. And there is a theory in macroeconomics, which is all about expectations and expectation augmented interest rates. But basically this idea that a 5-year rate should be the same as a 1-year rate now, plus times a 1-year rate in a year's time, and then a year's rate in 2 years' time, and a year's rate in 3 years' time, and a year's rate in 4 years' time. And then the only thing that should vary from that is the risk premium, which is the longer the time horizon you have, the more risk you're taking on. And so if you imagine that we're not in a recession and we're not expecting interest rates to change at all, then all of those 1-year expectations should be the same. And then the only thing driving differences in the interest rate should be the added risk you're taking on from the fact that you have what's called term premium, which is you're holding them. And there's 2 reasons for term premium. I mean, we can get into it in more detail, but basically reason number 1 is holding for 10 years is riskier than holding for 1 year. And reason number 2 is holding for 10 years locks up your money. And so then there tends to be less optionality with your money, and so you have to pay to do that.
So an opportunity cost.
Exactly, yeah. And so those 2 things should mean that a normal rate curve should just be up, should be like kind of up, like downward sloping, where the short-term yield is lower than the long-term yield, and so therefore the short-term bond price is like relatively higher than the long-term.
But you know, just can we put into context what magnitude, how important term premium is, and people understanding what, how much that counts for in
so term premium, I think in the short term has been kind of reverting a bit more back to historical levels. So normally what you would see is the difference between a kind of 1 year and a 10 year is about 0.5. Of interest rate, or 50 basis points. During the low interest rate period we've just come out of, it was basically non-existent.
Yes.
And so now we're getting closer back to what we'd expect, but it's still kind of lower than historical term premium.
And if we go to a world where, as suggested in the Financial Times this morning, you know, the debt bubble, actually people start to focus on it and realize that the US just can't continually run a budget deficit to fuel consumption, which, let's face it, that's exactly why the stock market is where it is now, and why valuations are where they are, and why the US keeps going up, why it outperforms the UK and Europe, you know, taking the AI premium out of it. But the US has bought that outperformance. If people start to look at the projections for interest rate repayments, and there is a dose of reality comes, what happens across the board to term premium?
So, well, I think you'd see 2 things. I think the first thing you'd see is the term premium would get worse, and so we get much more close to historical norms, where the short-term interest rates would be significantly lower than the long-term interest rates, and so the cost of short-term bonds is going to go up, and the government is going to have to pay more to borrow on a longer time horizon. So the government is going to essentially get penalized for the deficits in a way they haven't historically. I think the other thing worth keeping in mind is just generally what happens to interest rates, and actually more borrowing means that interest rates are probably going to go up for the government.
And of course, this exacerbates the problem, because as we get the necessity for refinancing, right, as the government continues to grow the debt, and long-term yields go higher, then it's going to get more expensive, and the whole debt repayments.
Well, this is exactly what's happening in Japan at the moment, actually, where and there's basically 2 paths out. Path 1 is you try and get your fiscal house in order. That's what happened in Greece, where through a very, very painful period of austerity
and stock market collapse.
Yes, and unemployment, there was large structural reform in the fiscal situation. And that was, to be honest, probably not voluntary. I don't know if anyone remembers the Troika, where the ECB really, really pushed hard on Greece. And actually right now you're seeing some similar problems in France, and we'll see if the ECB is as tough on France as it is on Greece. I think that'll be an interesting situation to look at. You can get your fiscal house in order, or you can do what Japan's doing, which is the central bank itself can start buying up more and more of the government debt. To a point where then you get into situations like yield curve control, and that is an alternative path. We don't know how that's going to go, because Japan is the first people to really try it. But at the moment, it seems like kind of under control, although they've also had a period of like massive stagnation, inflation, or even deflation has been, or lack of inflation or deflation has been a problem. So I think it's definitely a situation where of those two paths, it's going to be interesting to see if we ever get to that point, which one the US takes.
Yeah. Excellent. Isar, incredible as always. We're getting hounded out of the studio.
Yeah, sorry, I wanted to talk about Bank of Japan. We should do that maybe on another day once
Let's do that.
the Bank of Japan's made their rate call.
Excellent. Right, back in 5 minutes with Pega.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
To find a list of all your open trades, click on Positions in the sidebar menu on the left. Here, you'll be able to see key information about each of your trades, including the market name, the size of your position, the opening price, the stop order you chose, and your limit order. You'll also be able to see your profit and loss. Positions are normally sorted in descending order of your latest trades. To change how your positions are listed, you can filter your view by clicking on your preferred factor, like which trades are making you the most money, by selecting profit and loss. You can edit your limit order or stop order by clicking on the figure and entering your desired number. Lastly, you can close your open trades by clicking on the Close button next to the relevant trade.
Hi, I'm Sean Murison, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Welcome back to Teaching Pega to Trade. So we had a week off. Pega, tell everybody, why did we have a week off? And when did we last see each other, if you just reminded me now?
So we had a week off because I was in sunnier climates. So I was out in our UAE office in Dubai, and that was really exciting to be out there and just get a sense of the optimism of the market out in the Middle East and see how much that market is really growing.
It's just buzzing, isn't it? Just business is taking place everywhere.
It's really exciting, and everybody wants to talk about markets all of the time. So, people are really interested, and one of the reasons people move there, of course, is to increase their wealth. So it's just top of mind for people all the time. So that was really good fun.
And so what was the general market chatter? Is it about local stocks, or is it about America, or?
So the big topic in Dubai at the moment is all about crypto. So they have a new regulator that really focuses on digital assets out there. VARA, and then also Abu Dhabi regulators are trying to promote more crypto business in Abu Dhabi. just next door to Dubai.
Right, and this is throughout the whole blockchain rather than crypto itself.
Yes. So all around, every aspect of it. So they really want to become the leaders, and a lot of the public is hugely interested in the product. But, in addition to that, everybody is looking to increase their wealth. And so, of course, we know there's a number of different options available for that.
Very good. And that, of course, was a fantastic segue from Pega to go on to today's lesson. So we can take a look at on our slide. Today I want to get across the idea that literally you can express any view you like through options. So we're going to have a look at the Tasty platform, and also that you can decide the exact week you think a stock is going to move to an exact level. And we'll go through that with an example. You can also use options pricing to work out exactly what expectations the market already has. So it gives you clues as well as to what the move is going to be on, for example, a set of numbers. Okay. So welcome to Tasty. Welcome to the Tasty Trade platform, which of course is embedded in the IG platform in the UK, Pega.
Okay.
Now, have you had a chance to play around with the system at all, the platform?
Only the last time I was here before the Christmas party. So, a bit foggy.
You have to tell everybody, as soon as you sat down in the chair there, you said, "Oh, do you remember the last time we saw each other?"
Yes, it was on stage at the Christmas party. So, Rich and I, I think we like to get together on and off camera. dancing on stage, showing everybody the moves. That indeed, it was a great Christmas party. Well done. Oh, thanks. I wasn't involved, so well done to our social committee.
Great move by the social committee. Now, so let's look at the platform. Here we've got Nike is the stock that I'm going to use as the example. Now, what's your experience and understanding of Nike as a brand, and what's going on just now, Pega?
Yeah, well, most of what I know about the Nike brand is from that movie with Ben Affleck and Matt Damon. Do you know the one where they get Michael Jordan signed?
Of course.
On?
Yeah.
And so I think they like their iconic swoosh sometimes go up, but go down, but ultimately always go back up in direction.
And so this could be a follow-up to the movie of what's happened in the last 4 years. So John Donoghue came in from Bain and Company.
Yep.
So you put a management consultant in charge of a fashion brand. Mm-hmm. Weeba. He destroyed it. Absolutely destroyed the Nike brand. And it's actually really bad marketing for management consultants as well, because it's showing that they go in, they chop jobs, but what do they actually do running a business? Because this guy was the head of Bain, right? So management consultants have kind of got to get their reputations back up as well. So John Donoghue really destroying a lot of value, not just in Nike, but across the board. So now we've got a Nike lifer back at the in charge. So Elliot Hill, 25 years in Nike, has come back in to rescue them. Okay. But that takes time.
Yes, it does.
So the problem we have is they're reporting numbers this Thursday. And if you go into shops now, Nike's at the back of the shelves.
Yeah.
So what was the last pair of shoes that you bought, Pega?
Oh, in terms of sneakers, trainers?
Yeah, sneakers, yeah.
Yeah, they probably, I probably don't want to admit it because now, extremely uncool in the face of, Rishi Sunak.
Oh, yeah,
sneaker world, but probably, I think probably a pair of Adidas.
Yeah.
But I think I buy shoes for my son, perhaps once a fortnight. They seem to
And
just.
have you gone for a brand with those ones?
Yeah, so I think his Adidas, the quality doesn't seem to be amazing for kids' shoes. So I've switched to the Gola ones.
Gola
And those
ones as well, right?
I think that's a British brand, even though it doesn't sound British.
Very, back in the
They're
day.
like good, sturdy.
A lot of people had Gola football boots.
Indestructible.
Yeah. So, but the problem being every cool person has been wearing Sambas, right?
Yeah.
All the influencers, everybody and yourself have been in Sambas. Nobody's been buying Nikes. It's just become uncool, is what Money Week said, that John Donahue had made Nike uncool. So that doesn't, people in the street don't care that there's a new CEO.
Yeah.
It's going to take him a lot of time to rebuild the strategy, rebuild the company. Now, there's a chance that we hear about that on Thursday night for the first time. But the way that Nike report numbers, they report numbers at 9:15 p.m. And the numbers, Foot Locker says they're terrible. And also China consumption, pretty terrible.
Yeah.
So the chances are the numbers will be bad, but then we might get some kind of strategy update on the conference call, which is an hour later, or we might even get a date that will be an investor strategy day, and that's the first time you'll see the rebirth of Nike.
And yes, and there's a huge opportunity, I think, for the brand because, I think that whereas some of the other brands have gone like fashion, Nike has always been a real sort of athletes brand. And so if they can get the right sort of athletes to partner with, I think there'll be a huge opportunity for them.
Well, you've actually nailed it, because one of the things John Donahue did is the company was split into, football, track and field, training for the gym, tennis, golf. He did away with all of that. He did away with all the expertise in each segment, and he put it into men's, women's, kids.
Yeah.
And that was it. So he literally ripped out the heart of the company. So it'll be interesting to see if Elliott Hill puts that back in. And that could be what we find out. But how do we use options to express that? Well, what we can do is we can, as we know from before, we can buy puts in the near term, or we can pick a level where we might want to buy the stock and we'd be shorting puts. So if we take a look at the platform again, you can see here's all the dates, right? And this is the expiry. You can see how many days until each one expires. Now, luckily, we've got a monthly expiry this week.
Okay.
So we can actually trade Nike when the options expire only 4 days away. So if we had a really strong opinion, then we could trade that one. So let's have a look. So I've just clicked on that.
Yes.
And the stock is currently at 77. And how do we tell that on the system, Pega?
The yellow line that goes straight across.
That's exactly right. That's where the stock is trading, and specifically the little circle there.
Yes. Okay.
Now, one of the great secrets is up here on the far right-hand side, this is what we expect the stock to move by in dollar terms by the time of expiry. So we already know the options market saying it's going to move $6.
Okay.
So that gives us an idea. If we think that...
And that's in 4 days' time.
That's in 4 days' time.
So the market actually, even though we are expecting to see low results, the market still believes that the share price will move up.
No, that's a very good point. This is talking about moving up or down.
Oh, I see.
6.
So that's the sort of standard deviation, like on either side. It could move within a window of. So is it double that? So it's a window of 12, or is it sort of 3 up, 3 down?
So it's good questions all round. It is $6 up or down.
Okay.
So a total of 12, a window of 12. And that is what is shown by these blue lines in the platform.
I see. Okay.
So that's your expected move, right? So if that's 70, which kind of makes sense, then how do we put forward a view that we don't think it will go much below 70?
So if we think that it won't go much below 70, right?
That's right.
And so then,
or if it does, we're happy to buy them there anyway.
So that's the call option.
No, that's selling a put.
Oh, selling a put.
Selling a put. So because
we need to have the put already to then be able to sell it?
No, because you can short things. Remember what we did?
Okay. Yes.
Buying things and shorting with a rugby ball back in lesson 2, I think it was.
Yeah.
You can also short options.
Okay.
Right?
Yes.
Now, we went 2 weeks ago, we said, right, buying a put is like buying car insurance.
Yes.
So then shorting a put is like you being the car insurance company.
Yes. Okay.
Right? So what essentially we're doing is we're ensuring Nike share price doesn't drop below that level. But if it does drop below that level, it's then our problem and we get the stock.
Okay. But we don't think it's going to go much below. So we'd be comfortable with that.
I'd be comfortable with that because I want to buy the stock, because I think it's literally going to do the Nike swoosh.
Yes.
Right? So essentially we'd be buying stock in this bit here. So even if we get hit on stock and we get stock put upon us, then I want that anyway because I want it to go higher.
And when would you sell a put? So short a put versus buy a call. Because both of them give you the option to buy at a specific price, right? Or get stock at a specific price.
Exactly.
So why would you use one versus the other?
And that's when we have to decide when we think the swoosh happens.
Okay, so it's about timing.
It's all about timing. And that's the great thing about, with trading shares, you can choose, right, I think it's going to go up, or I think it's going to go down, or I don't trade at all. With options, we could literally, we go back onto the platform here, we could sell this 70 put on for Friday. Okay, ignore that one just now because that's an existing position I've got. But we could sell this put here for 49 cents.
Wait, are you taking different positions than you're suggesting for me?
Oh no, I've had this one on for about 2 months already, I think, with the same idea in mind.
Checking.
So remember that. Well, 50 cents, let's say we've sold that for.
Okay.
Okay? Because then we're going to go a bit further out and we're going to say, right, Elliot Hill is going to give a strategy update. And he's going to come up with this wonderful strategy to give Nike some kind of rebirth, and that it's going to take 3 months to get the market excited about that.
Yeah.
Right. So maybe we look at February. Okay. So now the 77, we think the numbers are going to be terrible on Thursday. So maybe the stock comes down first of all, but then it as he gives the strategy update, it starts to give more belief.
Yeah.
So what we really want is some strong upside into February.
Okay.
So then you look on the left-hand side of the platform, Pega. And more like down here. So how much do we think it can go up? Remembering that it's really been disappointing.
So again, can we sort of see the plus or minus in the top right-hand corner, maybe?
Excellent work. But yeah, just to give you an idea, it's come down all the way from 95 with a profit warning, and even further out than that. If we look at the much further, That's just having a think about it. Yeah, there we go. So there's, look at that, all the way. The first warning was from 120.
Wow.
And then down to 96, and then as low as 70.
And what is the time frame we're looking at here?
So that's from the start of the year, and we can go back as far as the start of 2023, and the stock was trading at 124.
Okay. So we think we can look at sort of the plus or minus, and a strategy helps the share price, but a strategy isn't actually delivering yet.
Not in the numbers.
Yeah. So so I would say I don't think that we'll be back at sort of like the highest levels, because I think they won't have actually shipped product out to people and they won't be seeing the revenue.
No.
But I think the market will give them a little bit of a bump for a plan to get there.
And you know how it does that. This is your first test.
Oh.
What happens if you're not seeing the actual profits come through in the numbers? So your earnings per share hasn't changed. It's still $2.60. But the share price starts to go up. So you scratch your head and say, right, the earnings hasn't changed yet, but what is being expanded? What number is going higher?
The alpha,
now, what lesson did we do for when you're building blocks on top of each other?
yes. So it's the confidence, and then
That's right. The valuation. And valuation is earnings per share.
yes.
You take the share price and divide it by the earnings per share, and you've got the X factor, which is the PE ratio.
Yes, the PE ratio, the price per earning.
Price.
Yes.
Exactly.
And we were able to sort.
Yeah, and we
Using
looked
that.
at the bigger range. So the average in America just now is 23 times earnings.
Yes. And what is Nike? Do we know?
Well, so Nike's on about 25 times earnings.
Wow.
But if you really believe that earnings are going to be much higher in 2 years' time, once the strategy has worked, then you can make the multiple higher now because you feel like it's going to come down quicker in the future. Because that earnings out there is going to be, because it's price divided by earnings.
Yeah.
So the price is going to be divided by a much bigger number, and therefore that PE in 2 years' time is going to look lower.
Yes.
So maybe we could take that out to 30 times.
Okay.
So the stock at the moment, the earnings at the moment, are $2.60 a share.
Okay.
So if we go to 30 times earnings, yeah, even that's only $78.
Oh, wow. And it's 77 now.
And that's, pretty much why it is where it is. So you can see that, the earnings are really struggling.
Yeah. And so other people, I guess, must think the same thing we do, that it's going to come back, which is why it's able to hold that slightly higher PE ratio.
That's right. But that
Compared to
gives
the
us a clue
average.
that it probably won't go too far
Okay.
in the short term. By February, there's no way it's going to get up to 100, for example.
Exactly.
Now, you asked a great question. What's the expected move? The expected move by February is $8.33
Okay.
up in that corner
From the 77.
from the 77. So you see your blue line there just above 80. That's interesting. 87.5. So yeah, we if we wanted to buy upside there, then it would be something like going long at 80. If we can get the platform up, please, guys. Going long at 80, so that's buying a call. So I'm clicking on that offer price.
Okay. And that's
$3.95.
$3.95.
Yeah.
80 for 3 months. And then, that's $3.95 per share
per option.
per option.
Yeah, exactly. Yeah, but
and each option gives us the ability to buy one share. Is that right?
well, there is a multiplier, but yeah, it's
Okay.
$3.95 of the share price. You're right.
Okay. Okay.
Or about 5%.
Okay. Yeah.
So you're paying 5% for that. Now, what we can also do is we can say, okay, but we don't think it's going to go above 90
Right.
in that really short amount of time, because that would be on a crazy PA ratio. So we can sell that one. Now, what does a call give you the right to do in the future, but not the obligation?
It gives you the right to buy it in the future.
Correct. So if you're buying the call at 80, but you're selling a call at 90, what does that mean that you, if the stock price goes above 90, what have you done?
You can sort of make money on the gap.
That's right. You're buying at 80 and you're selling at 90.
Yes.
Yeah. Excellent.
But it has to happen for you to make money, right?
It has, well, yeah, it has to go through, exactly. Otherwise, you just won't take up the option.
Yes. So then that's the sort of insurance that you have, like the ability to do it. But if, like, you know, if you don't get into the car accident,
Or you don't want to go to the concert, was the other one.
You don't want to go to the concert. If you don't, if the share price doesn't actually happen, then you don't have to sort of exercise your right. You just, wait until you have the next opportunity.
That's exactly right.
Okay.
So how does that all come together then? So we also think it won't go below 70. So we'd sell a 70 in February as well. That all comes together with the following, right? Where right. So we've sold a December put for 50 cents.
Okay.
We've sold a February put at $70 for $1.50.
Okay.
Then we've used that money to buy a call of paying $3.95. And we've sold a call at the 90 level, which we do have another screen so everybody can see that. And that comes to a net payment of 55. Okay, so we'd have to pay 55 cents only to buy the stock at 80 and sell it at 90.
Okay, I was going to say, so have we spent like $7 here? No, we haven't, because they are offset against one another.
Exactly.
Okay, cool.
And that literally is the Nike swoosh.
And actually, we're not spending too much money to do it either.
Less than 1%.
It's like practically, economical. It's
So, and what you do is you take the payoff, the total payoff is $10, and you divide that by the amount that you're paying, which is 50 cents.
right.
So you're getting a 20 times payoff.
Yeah, that's fantastic. I mean, if it happens, right? So
If it
we
happens,
have
that's
until February.
That's right, for people to start believing in Nike again, not buying the product, but just believing in the strategy. And that's what I wanted to sort of show, that, these options are incredible, because you can say, okay, what's going to happen this month? What's going to happen in 6 months' time? What levels am I happy to buy the stock at no matter what? What level am I happy to sell the stock at? What's it not going to go above?
And if it happens, like if people start believing in January instead of in February, then we're still okay because the share price will have gone up, right? But if people don't start believing in the Nike plan for like 6 months, though, then perhaps we're in a little bit of trouble. So it's like the price.
No. Because what you then do is you roll it, and you roll the expiries and you do pretty much the same thing, but for another 2 months' time or 3 months' time.
Okay, and then, so we can roll our position and just sort of continue to pay that small amount to sort of keep it going. So there's no, you don't have to be too worried about timing. You just need to stay on top of your position.
I'll give you the perfect example of rolling a position.
Okay.
Ronnie and I had a bet as to where the Aston Martin price would finish 2 weeks ago.
Okay.
He said above 101, I said below. And it was 105. So I owe him a coffee.
Okay.
Okay, it's fine. It's a coffee. So I go double or quits.
Yes.
And I say, right, by next Friday, where is it going to be, above or below 105? He said above, I said below. So
it's a double or nothing position.
So I've had to roll it again.
Okay.
I said, okay, by Friday, just gone, this time we're betting for a full lunch, not just this coffee rubbish. We're going for lunch. And this time it was below or above 109 and it finished at 105. So I win in the end because I've rolled the position twice.
Okay, so now not only has he missed out on his coffees, he's missed out on his coffees and he has to buy you lunch.
I did actually, no, because you've got to pay your premium.
Okay.
So I did buy him his
You did.
coffees.
Okay.
And now, Ronnie, I'm looking forward to that lunch. So there we go. That is a huge lesson, Pega. We've done so much there.
Yes.
And I know that you go back and watch them again and go through and make notes and everything. So yeah, that's definitely one to go back through and watch.
Yes, I will do. You will be not surprised to hear that watching yourself on TV is not so enjoyable. So I'll have to go through the slides again without having to watch myself.
Good stuff, Pega. Thanks so much. We'll see you next Monday.
See you next
No more
Monday.
holidays in Dubai for you. And we'll see you in 5 minutes, or at least Angeline will, as yes, she got Axel for your technical analysis rundown.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Bring me the next shiny new thing. Bring me the next shiny new thing.
I'm Ben Hemmington and I head up the sustainability function here at IG Group. IG Group pledges 1% of its annual profits and directs this to community initiatives. This is a pretty significant amount of money. We're talking several million each year. And I used to work in the charity sector, so I have first-hand experience of just how much of an impact this money can actually have if it's used wisely. In particular, we are focusing on empowerment through education, so looking to see how we can empower members of our community that are disadvantaged in different ways by providing access to quality education. It's an area of work that we're really proud of and that we're having a really excellent impact in. On the IG Group website, we have a download centre which has got lots of information about our sustainability function. Here you can find out more about our product governance, about responsible investments. We have documents around our diversity and inclusion, including a D&I statement, KPIs and targets, as well as our progress against these. You can also find a number of documents relating to how we manage our environmental impact. And then also on that download centre, you can find our community impact report that talks all about our Brighter Future Fund and the impact that it's having.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Hello, trader friends. Welcome to Live from the Trade Desk, where we're joined by Axel Rudolph. Axel, thanks so much for joining us. How was your weekend?
It was fine, Angeline. Thank you. It was all good. What about yours?
I was not feeling too well, and which kind of solidified my suspicion whenever anyone says, you know, let's have turkey. So I have several things that are in play already. I already have tons of relatives arriving. It's also Messiah season, so I feel like the unglorified taxi driver that's continually just driving them back and forth, rehearsals, performance. But someone fed me a turkey sandwich because I didn't have time to eat, and that gave me some weird tummy bug. So I wasn't well at the weekend.
I'm sorry to hear that.
I don't know, how do you feel about turkey? Do you like turkey or not?
I actually prefer goose, but my wife prefers turkey, so we have turkey for Christmas.
Nice. I mean, it's better. I think it's not as dry as turkey, right? Yeah.
Well, goose is supposed to be dry if you don't know how to cook it. But yeah, in Germany they have goose, and I prefer goose, to be honest.
And of course, you know, turkey is very much an American thing that's come over here, because you're right, it used to be goose here, right?
Yep, I believe so.
So speaking of which, loads and loads of our trader friends asking about, you know, obviously what could happen this week in terms of, you know, all the financial assets, because it's Fed week. That is like the key pinnacle, the highlight of this week. Will the Fed sound and give us an overview of what's going to happen and update the dot plot? We've got Adam Laluz asking for your perspective about the Fed meeting this week, if you've got time. Carl Wolf as well asking what your view is ahead of the Fed. Before we get to
Okay, well, first of all, I've tried something new today. I did a market wrap-up and an outlook for this week. So I wrote an article on that, and that's just being prepared by the people who uploaded to the website. So that should be out soon on the website or platform. And you can see in there what I think. But basically, long story short, for those of you who don't want to read it, I think there's a 97.1% probability that we will see a 25 basis point rate cut by the Fed on Wednesday. So that's widely anticipated. The question then is the Fed going to hint at what it is going to do in 2025? Right now, the market is pricing in another 225 basis point rate cuts, so a total of 50 basis point rate cuts in 2025. But what we've seen last week, and that's why indices such as the Dow Jones Industrial Index has come down for 7 straight days in a row, and the S&P also was slightly weaker. Even though I have to say the NASDAQ 100 continues to plow on and make new record highs. But the reason for the other two indices coming off is that, once again, because of the inflation data coming out of the US CPI and PPI, we are worried about inflation creeping up from around 3.5, 3.6% in the US. And you could see yields in the US last week rising quite significantly, and that's put a little of dampener on most equity indices except the Nasdaq. So the question is, what will the Fed, what will be its guidance? Because that will very much impact where yields are going to go. If yields continue to rise and rise faster, we could see a dip in this upward momentum we've seen. Another worry I have longer term, maybe for the next few weeks and into the beginning of next year, is that if you look at the strength and the breadth, it's called the market breadth of the underlying market, the S&P 500 only has 31% of stocks which are beating the index with regards to their performance. What that basically means is that the S&P 500 is mainly driven higher by tech stocks. And if you take those out, it's actually falling. And well, you could argue that's been the case last year and this year, which is true. But it's only the first time in the last 70 years that we've seen that for 2 consecutive years. And also, it's at levels now we saw the 31% I just mentioned back in the dot-com bubble, 1998, 1999. So perhaps we're heading towards a scenario where all these valuations with regards to tech can, at some stage, no longer be basically maintained at the current rate, and therefore we could see a sell-off. So I'm not saying it is going to happen, but I am basically looking at tightening my stops on long positions because of that, because potentially we could see quite a lot of volatility at the beginning of next year.
Thanks, Axel, and Carl and Adam. Lou's also sending their thanks to you. Let's take a look at an instrument that could potentially also move on this, if not already. I know you've been writing and talking about gold as well. Gold, of course, one that I watch closely and has been just taking another look because I was watching this closely on Friday as well, and we've had a bit of a softening, but it has. This is let me show you the daily chart here. I'm going to whack up the daily chart. But
you can see we basically failed at resistance, haven't we? Once again, the same resistance we failed at a few weeks ago.
Yes. Yeah, you're right. And then now it's slowly inching back up to, I don't know, you tell me whether or not we're going to try it again to breach that resistance. But I've been watching this very, very closely.
Yes, I mean, what I've got is from that low in the middle of our chart here, a series of higher lows, but we haven't got a series of higher highs because, as you said, we've been capped by that resistance so far. So what I've done, I've drawn a support line from the lows on this chart up to the today's low, basically, and we'll see whether we hold. For me, technically speaking, above. I think on the spread bet we are offering it's $2,612 to $2,605 per troy ounce, which is a support area. As long as that holds, the trend is just trading sideways, but overall it's still bullish longer term. And we'll have to see whether we can eventually break through that resistance area we tested last week or not. If that were to be the case, we could be heading back up again towards the 2,800 mark. Now, obviously, will also depend on the US dollar. The US dollar remains relatively strong at the moment, and also because of those higher yields I just mentioned in the US. But we'll see what the Fed will do on Wednesday and what the impact of that will be on the US dollar and on the gold price.
If we fail to break through, where do you think gold will go?
It'll probably just sideways trade, between those levels. I think 2,720 to 26 on the upside, 2,617 to 05 or 12.05 on the downside. So as long as we do that, it's just a sideways trading range. If it were to fall through the 2,600 mark or so, we could perhaps go back down again towards the November low, which was, I think, at 2,537.
Yeah, that's where I have my last golden line there. Also, we're coming to the end of the year, Axel. Do you expect, I know there's no way anyone can tell, but geopolitics have obviously also moves gold here. Are we likely to get a bit more of a respite, or are we likely to see some surprises at the end of the year into January?
Honestly, no one knows. I mean, what usually tends to happen with regards to all markets, not just gold, is that the week is the sort of last week where markets tend to move a lot, because then everybody's just in a festive mood and doesn't really care about financial markets anymore. So you sometimes get a little bit of adjustment just after Christmas, because there's much volume going through the market. So some market players can move it whatever market you're looking at, quickly with high volatility and low volume trading. But most of the time, nothing much happens, and a lot of traders take money off the books and just stop trading. And don't forget, I mean, we've got earnings season kicking off again quite early next year, mid-January. So it will all kick off again then.
Totally, and not just earnings. Beginning of the year, we also have that CES NVIDIA conference as well to kick things off. So speaking of geopolitics, oil, we touched on that a bit earlier, but I've got oil whacking up oil for our trader friends there. This is the daily chart here. We saw some support from central bank rate cuts in Canada, Europe, and Switzerland as well. Do you think more support to come from those expectations that the Fed will cut rates this week?
That I don't really know, but I do know that the trend in the last week or so is actually bullish. We've bounced off that support area, which we tested, going back to October of this year. All these lows around 66, the high 66 levels, just below $67 per barrel, acted as really good support. You can see that here horizontally on your chart. And we're now heading towards the upper range, which consists of the August low and the highs made since October, November of this year, which are around $71.28 and $72.59. So that's the resistance area, which is likely going to be retested, and then it'll depend whether we can break through there or not. I don't think we will, because we are heading into this period of the year where volatility is probably, and especially volumes, is going to drop off. But we'll have to see. So not really that much going on. Also, if you look at the Middle East, it's not really been in the news that much of late. Last week's sanctions with regards to Russia led to the oil price rising again. So far, haven't had any fresh input with regards to fundamental news as we speak.
Great, and just checking in, we've got 1 more minute or less actually to go. I know you've been writing about the FTSE a lot. Just bring up the FTSE because we've got loads of trader friends here who either love or loathe the FTSE. I tend not to trade it. I do pick individual, for one of my pensions, I pick individual high divvy FTSE stocks for one of my pensions, but I don't trade it in terms of the index. But what is your view on the FTSE going forward? Vivian out there, call out to Vivian, who went to a Birmingham event. She only trades pretty much the FTSE, so she's interested to listen in to find out what you think about the FTSE this coming week.
Well, today is coming off. I'm just looking at my chart here, and we are testing Friday's low. And if we were to fall through there, I've got a support line going back to the mid-November low, and that comes in around 8,273 or so. So we'll have to see whether we can hold on that support line. If not, it's quite likely that as long as Friday's high at 8,333 caps, we might actually fall back down again towards last week's low at 8,235. So short term, the FTSE looks weaker than the other stock indices in Europe.
It does also, it's not being helped by that disappointing Chinese data that we had. Clearly, that's had a dampener on some of the miners and FTSE. UK consumer confidence also deteriorating in December. We're just talking at a party at the weekend where there were some UBS and HSBC people as well, kind of talking about how consumer confidence, doesn't seem to be sort of gaining strength here as we go forward. If anything, it's looking weaker. It is looking like it's heaving on my high street. I don't know about where you shop, but I've been talking to the shopkeepers, and they're saying lots of people around drinking coffees, but not as much buying as had hoped. What's it like your side of London?
I don't do any shopping, so I wouldn't know. My wife does all of that. No, but jokes aside, it seems to be the shops around here definitely seem to be full. Also, the high-end shops. I do think people are spending money. If they weren't, it would be a huge problem, because obviously retailers very much focus on Black Friday and then the Christmas periods to make their sales. And if we don't see sales to the extent we expect them to be, then we could get some really, really negative data at the beginning of next year. In Germany, it's looking a bit different. Germany seems to be heading into another recession once again, having only just come out of it earlier this year. So things are not looking great in France. As we know, the government, yes, we've got François Bayrou now as a new prime minister, but who believes that he can sort all of these issues out? I don't think anybody does. So the French markets are not looking great. I think consumer sentiment there is actually far worse than what we're seeing here in the UK.
Certainly, you know, he's got the same problems still in France, and I'm also not seeing yet, you know, the FTSE benefiting from, you know, this CAC 4. We have to wrap now. Carl Wolf Trading. I see that you've got a question from Axel. I will send that to him after the show, but we have to wrap up now for the next session, which is market measures. Thanks so much for being with us, Axel. We'll check in with you soon.
Okay, thanks, Angeline. Bye.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill, whether you're starting out or just looking to level up. We got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. regular platform feature highlights, and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Hello everyone, welcome back to Market Measures, where we do the number crunching so you don't have to. And today we are talking about estimating potential losses with BPR.
That's right, Ange. We are looking at, so the margin equivalent in Tasty is called the BPR, the buying power reduction. So that is used whether the position is appropriate for a given account size and to estimate the max loss for a trade. So today we're seeing if it is a good estimate. How does that work? How often do realized losses actually exceed the BPR, and how dynamic is it over the time that you hold it? So let's consider 45 days to expiry, 16 delta spider strangles held to expiration over the last 20-year period. When these contracts took losses, those losses exceed the BPR only 3% of the time. So that's 0.5% of the time if we consider all the occurrences in total. When the same contracts are managed early, their losses have never exceeded the BPR historically. For early managed 16 delta spider strangles, the worst case loss has been 61% of the BPR, and the average loss is only 7%. Comparing past losses for different contract types, the losses have averaged roughly 10% the BPR for most deltas. However, while BPR overstates worst case losses for 16 to 20 delta strangles, it understates worst case loss for 30 delta strangles. Another reason why less delta is safer.
That makes sense. And we hear a lot about this from the Tasty guys talking about, managing earlier, why they like the 16 delta.
It stops that capital getting eroded, doesn't it? If you're only taking an average of 7 to 8% losses, 7 to 8%, not 7 to 8% losses.
Cute.
Yeah. Then that's giving yourself a real chance there. Mm-hmm. So the buying power reduction of a trade tends to increase as the contract approaches expiration. The average BPR per 100 shares tends to range from 15 to 18 for 16 deltas, 16 to 19 for 20 deltas, 17 to 22 for the 30 deltas. These numbers would be smaller if implied vols were elevated. Now, although tighter deltas have a higher than average BPR, they increase at approximately the same rate across contracts. On average, the buying power reduction of the strangles tested increased 23% from the trade open to expiration. In comparison, the BPR only increased 12 to 15% on average from day open to the 21 days to expiry, time to manage that trade and potentially roll it.
Now, the probability of a loss exceeding the BPR is lower for market and commodity ETFs compared to stocks because their IVs are generally lower. And the strikes of these contracts are skewed to better encompass outlier moves. However, all this still means in about 95% of cases, BPR is a good measure of max loss and risk for trades. So there you have it on the right-hand side. The probability of loss is greater than the BPR. And taking a look at SPY, IWM, gold, GLD, Amazon. That's not gold, is it? GLD. What is GLD?
Yeah, it's the ETF for gold.
Yes.
Yeah.
And Google. And just a reminder, people, for those of you new to this concept, BPR is like, it's basically the cost to place your trade.
That's exactly right. So, and what are the takeaways from this study?
So for most contract deltas, strangle losses average roughly 10%, the BPR, when the contracts are managed early. BPR often ends up being a good measure of maximum loss. While BPR overstates worst case losses for early managed 16 to 20 delta strangles, it understates worst case loss for early managed 30 delta strangles. The BPR of an undefined risk trade typically increases throughout the trade duration. An initial BPR of a trade should be significantly less than the maximum per trade BPR. So this is why we often talk about staying small when trading, but trading often, because the fluctuations in BPR is one reason.
Excellent. It's a good one, because those BPRs, when you're selling strangles, then they can be quite lumpy. So
Lumpy, I love that. Is that a technical?
Yeah, it sounds it, doesn't it? Lumpy.
Lumpy.
So you're safe in the knowledge, that you're the chance, even if you max your loss, it's most likely not going to be more than that amount that's been taken off your account already. It is quite reassuring, because if you see at the moment, some of the positions on there do have lumpy capital required. So you can find that on your far right hand side. We can see there, 8,000, 4,000, 3,000, 4,000, 8,000. That is taking up some quite chunky. So that is the Broadcom. And as I said, that's selling the lopsided strangle 190 250s. And then the NVIDIA, exactly the same, selling the strangle for 115 to 193. Hopefully I've given myself enough room there on those. But yeah, they can be lumpy, can't they? Shall we have a look at the all sessions?
Yes, definitely. So, Terence, yes, shall we go to what's next to look at the all session stocks? Hey, welcome back. And this is the session where we are looking at what's happened in the all session stocks. Of course, all sessions are really one of the USPs here at IG. Just trying to manage my chart so it becomes a bit smaller so you can see this.
First of all, before we go into it, do not panic by Palo Alto, because there is a 2-for-1 stock split. So when we put this up, you can see Palo Alto showing down 49%. That is just a 2-for-1 stock split, so it's roughly unchanged. But we are seeing Ford down 2%. And the Chinese names, Alibaba down 1.3 as well.
And that is because of that really poor retail sales data. Is that right? Out of China.
That's right. Yeah.
Whoa. We're also seeing, some of the gainers like Micron Technology up 2.5%, but Reddit, all sessions down almost 3% there.
MicroStrategy up 6 though, Ange. MicroStrategy up 6% with that move in Bitcoin.
Oof. Yeah. And Supermicro is down 12.6%. So quite a few moves there. Let's have a look at the indices as well, because it's starting the start of a big central bank week, starting with the FTSE, which is down slightly. We had Andrew McKilvey earlier on asking about, FTSE, what's going to happen, and we had Axel talking about this. Carl, we haven't forgotten about you. Axel is coming back with a reply with detail about how to trade cable after the Fed. But this is the daily chart here. As you can see, sideways trending there, the FTSE, and not yet breaching that 8,000 level. Some other key central bank meetings, other than Fed, of course, the Bank of Japan as well. We'll get into further detail with that with ISA on Wednesday. Also talking for Andrew McKilvey with ISA about UK bond yields for you.
I'm short the 8,000 puts actually for January. So hoping that stays true. But yeah, Rio's definitely not giving me any joy there. I mean, I've been long those for £1 now, so I'm going to have to put a stop loss. Where are we going to go? 47.65 for the stop loss on those. And then Mercedes starting to go wrong as well. That was a good one with that potential restructure. So yeah, 54.70 on that one.
Don't forget Mercedes is also, vulnerable to China news because the Chinese love their 大三眼, which is what Mercedes is, the big small eyes. So they have nicknames, 大三眼, which is it just means big small eyes because some Mercedes have that small and big headlights.
Right.
Or Benz, which is
BMW.
Benz. No, Mercedes Benz. They just say BMW. But take a look at the luxury stocks.
Why is there no imagination for BMW?
I don't know, but they love the Beamers. They love them, absolutely love them. It used to be said that if you were worth your salt, you'd either be driving a Mercedes, which is Benzy, or BMW. But here we are with the luxury stocks as well, just showing that to you. Trying to zoom in. Yeah, there we are. Kering and Hermes and LVMH all down. Richemont still holding on there though, and got Swatch and Prada also down. So you can see the effect there. Next week, or this week rather, we still have quite a few earnings of note, which, I thought was going to be just central banks, but we have Micron Technology, first quarter numbers on Wednesday. And then we have your favorite on Thursday.
Big event.
What is he wearing? I'm looking across at your shoe.
No, I've got my Rag and Bones on.
I've got my A6 on, Monkey Man.
Well, Monkey Man's asking, is MicroStrategy up because of Bitcoin or because of the NASDAQ inclusion? So I'm guessing a little bit of both, but certainly Bitcoin up, I think 4% over the weekend, is it? So yeah, MicroStrategy up 6. Tough to tell. And Carl Wolf saying, give me a Hilux every time.
Oh!
I can imagine you in a Hilux, Ange.
Can you? Well, I
going around the estate.
All I can say is whatever car I've driven, it needs to have power steering and it needs to have that wonderful bum heater.
Right.
Button that heats up the...
Now, would that have made you feel better with your food poisoning at the weekend?
Oh no, it would not. I absolutely could not get out of bed, and I'm not going to have turkey for the rest of the season because I think it was the turkey sandwich. Stay away from turkey sandwiches, people.
Not the Pret Christmas one, was it?
It was the Costa one. Terrence's like, no, Costa.
Oh
Costa,
dear,
I rate
dear,
their
dear.
coffee actually, but I was waiting for my train and I was really hungry. So I succumbed, in London Bridge to the.
Well, should have gone to Greg's. Should have gone to Greg's. Yeah, there we go. There's the share price. My war with Greg's has come to a close. We're now friends. And yeah,
Let's take a look at the stock price. I heard
pretty
Andrew
impressive
McKelvey
run,
think it's,
actually. About a 10% run, but yeah, the 2.5%, I think it was on Friday. And whoa, it looks like Monkey Man told us he was retired on Friday. So has he been booking a holiday? Because look at Saga go, says Andrew McKelvey. Andrew, is that somebody at IG, or is that
Andrew was
is
Fred.
that Monkey Man?
It was producer Fred.
Oh, sailing close to the wind here.
So we have 40 seconds to go. So big week out there. As I mentioned earlier, it doesn't stop there, people. You think that after this week, you know, with all the central banks and the earnings, you think
Huge week.
Huge week. But also, as Axel rightly said, you know, it doesn't actually slow down. We come back in the new year and earnings start pretty quickly. Also, we've got the NVIDIA CES meeting, which is a huge one for those in the tech industry. I think it's the 7th of January. How's your...
So retail sales Tuesday,
Yeah.
1:30 on Tuesday, retail sales in the US. Then we've got building permits, so Wednesday's pretty dull until 7 p.m. when we get the Fed interest rate decision, down 25 bips, but we get the economic projections. Make sure you do your work for that. But we'll take you through all that on Wednesday morning, and then an exciting show tomorrow as well.
All right, we'll see you tomorrow.
Happy trading.
Has China done enough to reassure the markets with yet another promise of stimulus? That's what we're going to be focusing on today on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. It's been a busy week of data from China, lots of news to pour through and lots of ways to look at what is developing in the world's second largest economy. But perhaps the biggest news that we got at the beginning of the week was another bit of supporting information from the Politburo, which is a 24-member committee at the core of China's leadership, including President Xi Jinping, that seemed to offer another little ray of hope about policy stimulus. Now, the first bit comes from the monetary side of the equation. We can see here there's a helpful graphic from Bloomberg that has put together how China signals its policy intent. So we can see here that from 2011 to 2024, the sort of official moniker for this was a prudent, quote unquote, monetary policy. And what this announcement from the Politburo suggested was that in 2025, we will transition to moderately loose monetary policy. Now, of course, that is sounding much more downbeat and much more modest than what is actually implied, because, of course, the last time things were moderately loose was the GFC and the Great Recession. So the markets ostensibly looked at this and said, well, they're really going to turn the spigots on now. They're going to shower this market with money. But history does not quite suggest that the markets would find favor with that assessment. So here's another helpful chart from Bloomberg showing what moderately loose has meant. And we can see here dramatic rate cutting against the backdrop of the global financial crisis. So as we get into this moderately loose period, there's a sharp cutting of rates, and then rates remain low until we basically get into the prudent phase. But of course, that has not stopped China from aggressively easing in this phase. And indeed, you can see here, really from the start of COVID, of course, but from right here in 2022, most aggressively, China starts to cut rates. And of course, we've witnessed ongoing escalation in this sense. There has been ever more monetary stimulus that has been unveiled last year and quite a few times, as a matter of fact, this year. September was the last big splash, and we've since had more and more and more. We've lowered interest rates. We've lowered the reserve requirements for banks, which, of course, free up, or at least are meant to free up more capital that can go toward investment and spending. And we've seen a whole host of other measures, from shoring up the housing market to outright buying stocks, and thereby creating a level of, or attempting to create a level of upswell in consumer confidence to get people to spend, to get businesses to invest. So there has already been a tremendous amount of monetary stimulus. And the response has plainly underwhelmed. What we find is that when we look at how lending has worked in China, this is the Bloomberg Credit Impulse Index here, and what this measures is the share of new loans in GDP and overall economic growth, in other words. And we can see here that since the beginning of the year, essentially, this index has actually declined. Moreover, it is now, this level index, at the lowest levels we've seen since back in 2018. And the size of these declines is eye-watering, to say the least. The most recent numbers from October give us a 14.5% decline year on year, which was the fastest drop since February of 2022. And interestingly, of course, this is where in 2022, the beginning of it, where the rate cuts really start going. In other words, we don't really have much to show for this stimulus. In fact, things appear to be going exactly the wrong way. Now, what markets seem to again find a little bit enticing in this Politburo announcement was, again, a dangling of some kind of fiscal rethink. The statement from the Politburo saying that officials are looking to be more proactive with fiscal policy next year, which, of course, has been a major source of consternation for market watchers that have looked at China and said, well, obviously this monetary stimulus isn't working. What needs to happen is there needs to be a fiscal effort to actually create demand. And that, of course, has been the core issue in China, an absence of demand. In fact, if we look at this chart that we like to revisit periodically, this is China's GDP growth, nominal versus real, and then the spread between the two. What we find in the past 6 quarters now, so a year and a half, we've had real GDP running faster than nominal GDP. Now, let's unpack this arithmetic. Nominal GDP is the sum of the value of all the goods and services that are produced in the economy. But when you measure their value, there's obviously an element of inflation there as well, which can make the sum appear bigger than the core value of the underlying output. And so real GDP seeks to take out the inflation component, the price movement component, to get just at that. So nominal minus inflation is real, which means if real is running above nominal, then the inflation coefficient is negative. We're subtracting a negative number from nominal GDP, is the implication here. And that's this spread, which you can see is now in negative territory. But consider what this means. Economy-wide price growth is negative. That essentially means the whole of the world's second largest economy has been relegated to the discount bin. When there is demand, that demand tends to push prices higher as that demand chases the supply of goods. That demand competes on price for who will get the goods or services. And that gives you positive inflation, which comes hand in hand with demand and with economic growth, more baseline. What we're witnessing here is the opposite. There is no demand, or at the very least, it is incredibly anemic. And so things are being discounted to try to stoke that demand. An economy that's stuck in a deflationary spiral is essentially signaling that it badly needs for someone to be a source of demand of last resort. And of course, when we saw the same thing during the COVID lockdowns in the West, say the US or Europe, there were vast government outlays to get things moving while there wasn't that demand from the private side of the ledger. This has been something that China has vigorously resisted doing, even as it's promised tinkering at the margin fiscal measures like easing the credit position of municipal governments to perhaps let them spend more, lowering the ratios on down payments for housing to, again, try to induce people into markets. But what we end up with still is the apparent lack of uptake. As a matter of fact, a survey from the PBOC, China's central bank, showed that when asked what urban depositors would do with incremental money, they chose saving by a factor of close to 60%. Moreover, bank deposits are at record highs, which essentially means that all of this monetary easing, all of this provision of cheap money, cheap credit inducements is not creating demand. It's not creating loan growth. People are simply just stockpiling the money because ostensibly there is no confidence for demand and for risk appetite to rebuild. So what happened when China seemed to kind of tease more fiscal stimulus this year? Well, back in September, this was, of course, music to the market's ears. They soared almost 40% in China. This is the ASHR ETF that follows China's benchmark CSI 300 index. Those are the top 300 names listed in Shanghai and Shenzhen, essentially China's version of the S&P 500, a kind of catch-all equity index. Rapid expansion here, obviously, the first time China seemed to float this idea out there. And when it turned out that the measures that were on offer were going to be underwhelming, when we found that what the government actually had when it was talking about these things was a plan to buy up idle land and commercial properties, a plan, as we just mentioned, to shore up municipal finances. All this, again, started to look like inducements for everybody else to spend, but for the central government in Beijing. And once it became clear that a big fiscal package apparently wasn't coming, this move shed half of its advance very quickly. This big decline happens over just a week at the start of October, and then we settle in this narrow range. This was this week's announcement. So there was a bit of optimism, and that quickly faded, and we find ourselves anchored in the same area where we've been. In other words, the markets are looking at this, and they're simply not giving Chinese officialdom the benefit of the doubt until, frankly, they put up or shut up. Economic data coming out of China was also disappointing this week. We started the week with inflation data and had a set of trade numbers that came out later in the week. Here's the inflation data. It ended up being disappointing. We had a set of CPI numbers that gave us inflation of 0.2% year on year. That's the weakest in 5 months, whereas economists were looking for a 0.5% rise, which would have been an increase on the prior month. And of course, wholesale inflation, the PPI component, continues to be below zero, so continues to be in deflation territory. In other words, there is very little demand in this economy, and when it comes to the consumer side of things, we're basically at standstill. On the trade side of things, it was even less encouraging. Exports grew less than expected, 6.7% year on year against expectations of 8.5%. So that pop in exports that we saw in the prior month in October, widely attributed to importers primarily from the US, but other markets as well, trying to front run what might be aggressive tariffs from the incoming Trump administration, trying to get their Chinese imports in before those things pick up the price of imports from China for US importers, because of course it is US importers and indeed importers elsewhere, but certainly not China, that pays these tariffs. One country can't compel a sovereign other one to pay a tax. And so what we end up with when we have a rise in tariffs is essentially a consumption tax on importers from whatever country is hit with tariffs. But these are domestic firms that have to pay it, and there was a big over 12% year-on-year jump in exports in October that widely was attributed to people trying to front run those tariffs. What we have now has been essentially export growth that's been cut in half in terms of its speed, and needless to say, a disappointing outcome in its own right. But it was imports that really shocked the system. They were expected to rise 0.3%. Instead, they fell, and they fell hard, down 3.9% year on year, and an acceleration, an escalation, as a matter of fact, after a 2.3% decline in October. Again, stressing this idea that demand, especially on the consumer side of things, is woefully weak. It's not just Chinese markets domestically that got the memo here with this anemic response here. We can see China-sensitive assets, a similar response was there. So here's copper. China is the world's largest importer of it, and it is looked at as a proxy for China's business cycle. We can see it popped at the beginning of the week, but has since gone nowhere. As a matter of fact, has made a bid to erase pretty much half of this initial move. The Australian dollar has fared worse. It popped higher again at the beginning of the week, much as copper did, and has since given up all of those gains, and now looks like it's going to close down on the week fractionally. Although, of course, we still have a day left, so we'll see. But clearly, whatever pop there was to have from this Chinese news did not assist and did not hold, and of course, to some extent, a slightly less hawkish RBA helped on that front when they announced policy this week. But were China's news impressive enough to overwhelm that? It might have, and very clearly it didn't. So, perhaps the only impact that we really saw stick with markets and get market confidence this week was a move in gold. And it's because we got foreign exchange reserve data out of China over the weekend showing that for the first time since April here, China has resumed accumulating gold reserves. Now, we can see here that from 2022 through 2023 and going into the beginning of this year, China accumulated a massive amount of gold. And that, of course, helped to give us periods where gold would ostensibly decouple from macro dynamics and ignore, say, rising yields and a rising US dollar at the beginning of this year. Because through this period right here, China was still aggressively accumulating. After this pause, this bit stands out and, of course, suggests that given how long the previous run looked, given sort of the 18 months of accumulation that was there before the pause, that perhaps another long cycle is underway. And that certainly gave gold a bit of a lift here. It's correcting slightly if we look at today's price action, but the overall break here out of this consolidation and this narrow range clearly inspired and following along because, of course, yields are again higher this week, as is the US dollar for the most part. That should be kryptonite for gold, but nevertheless, it is on pace for healthy gains this week. So perhaps the markets will eventually benchmark the full stock of Chinese negativity from economic data and lackluster stimulus efforts, or perhaps officials will finally step up. But as it stands, the only confident thing that the markets find as far as Chinese policy is concerned is their attempt to buy more gold for their reserves. As for the reviving of the economy and everything related to all of that, markets don't seem to put much into those efforts until they see something actually materialize. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour, Mondays and Fridays, though we'll be off tomorrow. I am also on with Victor Jones for The Price of Truth on Wednesday, back with him and Tom on Sundays for First Call at the open of global markets in Asia and the futures open in the US, writing for the News and Insights portion of tastylive.com and opining on the platform formerly known as Twitter, as well as now on Blue Sky at Ilya Spivak. Thanks very much for joining. Macro Money's back next week.
What's going on, everybody, and welcome back to the Bad Trader. I almost said stream, the Bad Trader Show. Today's Thursday, just a day after trying to digest the CPI data with that massive rally we saw yesterday, Julia. But anyways, thanks for joining us, guys. And Julia, how are we doing today?
Dude, I'm doing okay. I'm not doing too shabby on this very, very, very cold day in Chicago. And somebody in my apartment's making a grilled cheese, and it's driving me crazy. But otherwise, I think I'm doing okay. How's everything going with you?
You don't like a grilled cheese and some tomato soup or what?
No, I want a grilled cheese right now, which is
they're
a
taunting you.
problem.
Okay.
They're taunting me. That's right.
I got you. Yeah, no. Yesterday, I mean, I'm doing well. No grilled cheese. I don't really smell anything, but I am a little hungry. But a grilled cheese does sound kind of good. I could use some carbs, but I mean, yesterday was just a massive day, Julia. What are your thoughts? I mean, 400 something points on NASDAQ. And
I needed that badly. I needed that. There was a huge rally in VST, which I put on a put spread right before it crashed 7%. It's had a really monster rally throughout this year. So I thought, you know what, why not? It's had very strong, consistent performance and then proceeded to sell off, but then recovered a bit yesterday, which I was very thankful for. Today we're a bit red, but finally made some money back on my gold trade. Gold has had quite the rally up until today. Finally, a little bit of a correction, which, yeah, I needed. But yesterday was green. Felt pretty good. We got Bob over in chat. Awesome to see you. Thank you for joining us. But otherwise, yeah, it's just been, sometimes you just got to hold tight. Sometimes you just got to, trust the probabilities and hope for the best.
Yeah, which can be some very difficult to do sometimes.
It can be.
Yeah, no doubt. Leaning on those probabilities. But before we do get into it, you said it's cold in Chicago right now. Has it snowed any at all yet? Or is that more so like January, February time? Or what is it looking like out there right now?
It snowed once, but didn't really stick.
Okay.
So
some slush. That's the worst. The slush. It's like, if it's gonna snow, please snow.
It slushed and then it iced. I think it's in here. Let's see. I use Celsius. It's -9 Celsius, which is like 10 Fahrenheit or something. 16 Fahrenheit. It's gonna hit a low of 5. But with the wind, it feels like 11, which is great. So I've been a little low energy today, but that's just me.
No, I got you.
But otherwise, otherwise it's been, pretty, I mean, there's been an awful lot going on in the market. Hey, Kat, what's up? Okay, sorry, there she goes. Otherwise, there's been enough going on in the market to certainly man, she's just on something else. Let me get this. Hi, buddy, what's up?
Yeah, what are your thoughts on NQ, Kitty? Like, what are your, I don't know if she was hitting the buy button, him, she, he, she, but no, it looks like we're day after CPI. We're kind of digesting the news a little bit. I mean, we sold off just a little bit from the highs of CPI yesterday. I'm really curious just to see how we're going to finish off the week. I was taking a look at the volatility index, and the little bit of the sell-off we got in the beginning of the week didn't seem to have the index budge any and all to the upside. So it seems like it's that natural, or kind of as expected, I guess you could say, kind of volatility into December, but. I don't know what it's going to take to see a little bit of a spike in volatility, but it seems any of the down moves hasn't really made it budge at all. So I don't think right now.
The Bears had 2 good days, and now we're back here. Yeah.
2 good days. What do you expect? I mean, all-time highs again. And yeah, I guess that's just been the story over the last few weeks. The all-time highs, and some of our trivia is going to actually be themed to around all-time highs. So not really Christmas themed, but kind of stand to rally themed. So we'll get into
rally themed.
Yeah.
So. We had a very big move in Warner Brothers today. That was up 15%. But when you're trading at $12.50, that's not really saying much. You kind of deal with penny problems at that point, penny stock problems. But this one's been interesting because this one has just gotten so beat down, honestly, since 2023, and like we're actually a little green on the year from what I can see. This was one of the worst performers in the S&P, and then it has since recovered, which is nice. And today certainly helped that out an awful lot. As well to the downside, Adobe just completely donked, but I don't really feel bad for them. I don't feel bad for them so much.
Well, what do you got against Adobe?
I mean, from my understanding, might have used like part of the terms and service for some of their design softwares, or that you kind of have to let them use the stuff that you create for their AI training models in order to even use it.
Really?
That's my understanding, which I'm not in love with that. But they said AI. They've said AI many times. This one's been as well, like a bit of a, I mean, especially maybe in early, just like in early 2024, just having a rough year as well. But yeah, I don't feel as bad for it as I probably should. And then let's see what else is going on here.
Valid. Got Oracle.
But what else are you watching in the market? Anything interesting?
Not really. I mean, just been keeping an eye on MSTR. I feel like, whenever we hop on stream, Luis brings up MSTR. So I'm like, all right, we're watching it. We're seeing how it's going to play out. But MSTR, the indices, kind of same story with the indices, checking out volatility, and just been a little bit more focused on the indices lately, actually. MSTR, I think, was the last underlying outside of the indices that I was really focused on. But other than that, just really focused on things like QQQ, SPY, those kind of things. MSTR is just one that is just leaving me on a cliffhanger. I feel like there's a little bit more, I don't know what the term to use is, but digesting on MSTR to go. And I've just been watching from a distance. So I think crypto has been really the talk of the town over the last 4 to 8 weeks. That's another reason why I've been really watching MSTR. So really just interested in those products that have some exposure to crypto. That's been top of mind for me, at least. Yeah.
Yeah, we were talking about that earlier today, and I think like for me, so I got my IBIT shares, my IBIT shares,
IBIT.
because like I'm bullish on crypto in sort of the long term. I don't really want like an expiration date on that assumption. And in the long term, short term, I'm expecting some price volatility. Bitcoin's been hovering around like 100K, kind of teetering. But in the long term, just kind of wanted some skin in the game. That's kind of my way of doing it. And I'm like, if I want leverage Bitcoin exposure, there's kind of other ways to get it as opposed to MSTR, because you're dealing with like other risks on top of that kind of inherently come with management. So for me, it's just kind of like not my preferred trading vehicle, although it's I believe about to get added to the NASDAQ. So that's great. But yeah, certainly been one to watch, down another 20 points today. And oh my God, Broadcom just reported. And somebody asked me about this today on stream about like, what are your directional assumptions around Broadcom? And I said, well, I'd be like kind of bullish just because a lot of the concerns around chips, around AI, kind of more recent, I guess, when it comes to, these antitrust concerns around NVIDIA, that was put forth by China, as well as some of like the more aggressive trade policies about raw materials that would affect like the semiconductor sector, specifically between that type of trade between, like China and the United States. Hi, babe. Oh, there we go. And I'm like, but you know what? That wouldn't affect their entire quarterly performance. So be kind of bullish. And of course, now it's up 30 points. And it's never when you actually have a trade on. It's never when you actually have skin in the game. Doesn't ever work out like that. But absolutely just shot. Oh my God, it's way over 200 right now. Okay, Broadcom.
And it looks like it's still moving at the moment. A lot of volatility in there.
Oh yeah. So that is a stonk if I've ever seen one, but I guess we got some time sort of before the open. And then Costco also reported this looks like a moderate donk.
I don't know. What did they do to their hot dogs? Yeah, what did they do?
They raised the price of their hot dogs. It's over. But that being said, Costco has just been like a beast this year. This has been just absolutely, especially since like October, November, just like on fire. So a little bit of a pullback is it's like it doesn't seem to be hurting it that much. It's also like not the biggest drop in the world.
I got you. What's the when's the next earnings for Costco?
They just reported today. I kind of was expecting more of a move compared to what we're seeing right now. It's down a couple bucks. But that's not really much. They reported, and then Surdizzle, thank you. I think the decision for MSTR joining the NASDAQ is tomorrow. I thought it was a done deal, so thank you for the correction. It sounds like it's not official yet. But the first thing I think of is like SMCI. It's like, it's up 1,000% this year. Let's have it join the S&P, and then immediately just sold right off. So in terms of like introducing some volatility to the indices, y'all. But what are you gonna do?
I mean, I wouldn't mind, personally for the sake of my account, I wouldn't mind if we have a type of a sell the news kind of event whenever that decision's officially made tomorrow, just because I do have some call spreads that I sold on the indices. So a little bit more of a down move would make me feel a little bit more comfortable. They're out of the money right now, but it's a little too close for comfort. So, I mean, I wouldn't mind a little bit of a sell the news event, at least temporarily for the next couple of days, for myself at least.
Yeah, I wouldn't mind that at all either. And I don't think anybody would be surprised if that happens. But that being said, we had some big movers, but overall in the market, like not a ton going on. Little tiny bit of a reversal, but like a 0.5% move in the S&P, that is like it's like well within a standard deviation. Standard deviation for SPY historical returns is like 1.1%, something like that. Qs, it's a bit higher. Russell down a little bit as well, and gold down, and bonds were down, which is like, that's kind of a weird day.
No, it is. You know what's funny? I know we were talking about
lot.
quantum. We were talking about quantum computing a little bit more recently lately, and everything on my Twitter feed. I don't know if it's picking up what I'm saying over here, but I've been getting a lot more information on quantum computing. So even just the conversation on that topic seems to be getting a lot more popular and relevant. Little sidebar, but that's one thing I wanted to bring up too.
I can't wait.
I know you can. I know somehow you're pushing the quantum computing stuff on my feed, Julie. I know it's you.
Well, I just I just don't want to, kind of don't want to hear about it, because like we're decades away from it being, I think, really practically relevant. It's still in like very preliminary research phases, but there's still like huge amounts of capital from like major tech companies that are trying to drive hype around something that's still very, very premature. And so when it gets on that hype train, a lot of the discussions become like annoying a little bit. I think it's important for everybody to be excited about it, but that's not always the context that it's presented, especially when it's like really hyped up as one of these topics. So you can just kind of see, like, I don't say misinformation, but like, incorrect descriptions of it kind of propagate compared to when it comes from academia, which has its own other communication challenges, but that's beside the point.
Yeah.
But anyway, what are you going to do? So I guess quantum computing, ooh, that's going to be the new, well, that is kind of what like ML was, like machine learning and AI was for a long time. It was like treated as this like very promising skeleton key to a lot of problems. And we're seeing like now that it can be applied to a ton of problems and can kind of like improve our ability to solve problems, not with like 100%, accuracy, but it's still, better than some of our existing methods. But it's certainly not a skeleton key that you can throw everything at. It's still like, you need a certain degree of nuance and literacy to be able to know, just like the internet, like, right?
Yeah.
There's internet literacy that you need to build. Same with AI, say like quantum computing, like talking about it. That's a whole other thing.
Oh,
But
that's great comparisons. It helps us kind of build a little bit more context about the state of what it might be in right now. So
yeah, it's kind of this. I mean, I was very, very small during the early internet days, but I anticipate that a lot of the concerns around AI are very much echoed. They echo the concerns around people adopting the internet and the World Wide Web and this like endless supply of information kind of at your fingertips. And like, right, there's a certain degree of literacy that you need to be able to use the tool effectively, and to not get like scammed or hurt or, learn how to take in all that information. So likewise, there's a certain degree of literacy, I think, that comes with AI, using AI tools effectively. We as traders maybe have seen some examples of illiteracy even just since ChatGPT came out.
100%.
But we're here to learn. And that's what it's all for, isn't it?
But it kind of
yeah.
seems like a space right now, just because there's going to be a massive barrier for entry in terms of even whenever quantum computing becomes more so relevant within society and solving issues. It seems like there's going to be a pretty big barrier just because that type of technology seems like it's going to be extremely expensive. So maybe right now it's also in a state of like a lot of speculation investing, maybe a lot of
100%.
venture fund, a lot of speculation for at least trying to get a piece of the pie without actually having the real thing. But we'll see what happens.
Yeah, it still seems like pretty preemptive. And like if quantum like technology becomes like quantum computing technology, quantum communication technology, once that becomes like commercially viable, like there's, in terms of priorities, like there's a lot of, I think, change that are existing. Yeah, like security infrastructure needs to have in order to be not vulnerable to those types of attacks. So that's going to be. Do you remember the Pope drip?
Can you remind me?
Did you ever see that? It was a picture of the Pope wearing this like blinged out necklace and this big puffy coat, and I thought it was real. And then it turned out to be AI. You remember we talked about that?
The literal Pope drip. Yeah, I remember exactly.
Like the Pope drip. That was like a scare, right? That was like, for me at least, I think for a lot of people, I didn't know it was AI generated. Found out it was AI generated, and that was like a scare. Like, oh, we really got to get our shit together, figuring out how to regulate this and how to how to use this properly. So I believe that to be the same when it comes to like quantum computing technology and all that kind of stuff. Like there's gonna there's gonna be some kind of like, oh, this is really a real thing now. We have to get our shit together sort of event.
That's a really good point. And even with quantum computing, maybe that'll make a little bit more of an argument with why, blockchain could be relevant, because I know, especially with the new age of AI and being able to tell what's real and what's fake. I know the blockchain is something that's going to be like a public ledger that can help us identify what's real, what's not real, what's legitimate, what's not legitimate. So maybe with even quantum computing and the coming of AI, maybe it'll make more of a case for why something like blockchain could be useful.
Yeah, I think so too, actually. I mean, and I'm not like super involved in the space, obviously, but to me, intuitively, that just seems like a great application for blockchain because you have like this publicly available, like mathematically verifiable trace of where something came from. So if you're concerned about deepfakes or, you know, like fake information or any of that kind of stuff, and there are like reputable news sources where you can trust the information coming from, that's potentially a way to create like, yeah, like an algorithmically verifiable trace to certain types of information. That being said, if the information kind of branches off in a ton of different directions, it doesn't necessarily mean that what you're seeing now is like false if it didn't come from one of those news sources, but at least gives potentially people the ability to point to something and say like, I can actually track down where this came from, and it's got a timestamp, and that's kind of like etched into this big shared thing that we all agree upon. And to me, that seems like, I think, one of the coolest applications for blockchain technology. I think that'd be cool.
Good point.
So what are you gonna do? I think I know what we're gonna do, actually. You want to hop into some trivia?
Yeah, let's do it. I know we got some slides before that if you want to get into some of these updates as well.
Let's do it. Are you able to see that okay?
Yeah, perfect.
Hell to the yeah. Okay, so first things first, we do have an app. We made some sick updates this week. We added market cap distribution. We added events to your portfolio page and some accessibility updates. If you want to go find it, you find it in the App Store and the Google Play Store. It is a fun community on there. And then as well, if you want to come throw your trivia answers into a chat, you can find us on Tasty Live's YouTube channel at Tasty Live Show. And if you want to follow us on Twitter, we're at Bat Trader App. It's pretty cool information that Luis finds to put up on there. So super, super duper cool. So all-time highs, that's the
Yeah,
topic?
the themes, yeah, all-time highs. That's what we'll get into today. We have a couple of trivia questions,
yeah.
so cool.
Let's do it.
All right. What percentage of the time does false breakouts occur at all-time highs in the NASDAQ composite? We got 4 options. We have A, 10%, B, 20, C, 30, D, 40, and then I'm gonna just throw in an E, all of the above. Which one are we thinking, chat? I know we've spoke about this almost very similar question. It's almost just flipped upside down now, but I thought I would present it this way.
Okay, so for all the uneducated swine out there who, just so that I know what a breakout is, like you're talking about, like I'm going to try to use my technical analysis. I think I've been around Luis enough. So something's trading in a channel, and then it pops, and then continues.
No, it doesn't even have to look like. It doesn't have to look like anything. All that it would be meaning is making another all-time high, whether that's a channel, whether that's whatever it looks like, just all-time high.
So what you're saying is that like a false breakout would be like the NASDAQ hits all-time highs, but then that all-time high doesn't continue. It just kind of sells back off.
Right.
Oh, okay. Gotcha. So basically once we're at all-time highs, how often does it reverse?
Right.
Yeah. Okay. There we go. Ooh. Oh, you know what? I actually know this one. I think approximately.
You see how I'm saying it's kind of flipped upside down from how we would usually propose the question?
Well, because I calculated this a while back, given that we're at all-time highs today, what's the probability that we're going to continue to hit all-time highs for tomorrow?
Right.
And I know, so there's a complementary probability of that. So I think I do actually know this one.
Yeah, 100%.
Hell yeah.
What are we thinking, chat?
Okay. All right, chat. What are we thinking? It looks like absolute beginner says A. Big Deal Donut said E. Not even an answer. I think you got that
All
one.
the above is E. Yeah.
All the above is E. Yeah. That's a good question. Okay, so everybody go ahead, take a second to throw your answers over in chat. I'm going to go ahead and give mine because I do remember these probabilities. Is it C? Is it 30%? Because I remember 70% is the complimentary one.
Exactly.
There you go.
Yeah. So C answers 30%. Fun fact: false breakouts occur often during low volatility or in highly speculative markets. And speculation tends to rise, especially at all-time highs, because we've never traded at those prices before. But yeah, it is I really tried to just flip what we usually talk about upside down. So the inverse, like you kind of said, would be 30% rather than the likelihood of putting in another all-time high, which would be 70%.
There you go. Yeah. See, pretty cool, actually. I dig this. And we're learning a little bit about some of the jargon, breakout jargon today. Super cool. Nobody in chat got it right, but 30% is actually it's a bit higher than chat thought. They thought it was 10%.
I did hear 10%.
Is the most common answer. Yeah, there you go.
Yeah.
Okay, what's the next one we got?
Awesome. So why are all-time highs considered areas of price discovery? I know this is a little different than what we usually get into, but we do talk a lot about
more technical analysis.
Ooh, no technical analysis.
This is not technical.
Technically, no
Technically.
auction. It's technically under the eyes of auction market theory and where
Okay.
buyers and sellers will typically find value. So we talk a lot about it. We talk a lot about it on stream. I know it
Yeah.
says I only use the terms resistance levels because it's just a common term that I think most people will recognize. But that's why we also have like resistance in there as well. But just kind of wanted to throw that in there. We talk a lot about it on stream, but why are all-time highs considered areas of price discovery? We have A, there's no historical resistance at these levels. B, traders rely on historical support levels. C, market participants avoid trading these levels. And D, volume is always lower at these levels. What do you think it might be, chat?
According to the auction price theory.
Auction market, yeah.
Auction market price yeah. Auction market theory. Why are all-time highs considered areas of price discovery? All right, chat, what do we think? It looks like there's a lot of A's. We got A's.
Okay.
Seems to be the most common answer. Again, there's no historical resistance at these levels. That kind of makes sense. Traders rely on historical support levels, not resistance. So I'm thinking of, but they're.
I guess the real term, yeah. The real term would be value areas. I just wanted to use resistance because it's a more common phrase used that people could pick up on. I don't want to use terms that people are like, what does that mean? Yeah.
And then we got a whole bunch of people, Metaphysics Magic, that's awesome. Bunch of people saying A as well. I'm kind of inclined to agree because I don't know why you would avoid trading at these levels or why there would be lower volume levels. I feel like volume would be pretty consistent.
We also have option E,
But there is also option E, which is none of the above. Okay, well, you know what? I've learned my lesson once or twice to go against chat, and I'm not going to do it. Is the answer A?
You're trading the statistics of chat. Yeah, the answer is A. There's no historical resistance level. Really, the correct term would be value areas because price typically likes to seek value, and whenever that is happening, we usually coin that price discovery. But price discovery allows the market to test new areas of demand supply without predefined barriers. Supply and demand, same thing as value. Again, I just thought I'd use terms that are a little bit more popular and recognizable.
Hell yeah. Super cool, man. Well, chat got it right. Good job, everybody. Y'all know your support resistance market theory, auction market theory. Hell yeah. That was a fun one.
Cool.
I think that's the end of our trivia, right?
Yeah, that'll be it for today. I was like, let me just throw in some couple all-time highs. I know we did Santa Rally, we've done Thanksgiving thing, and hopefully this is the top. Famous last words, but we'll see what we get heading into the end of the year. So
I dig it. Yeah, no, I feel like I'm learning a lot from these trivias these days. Do you want to try to do a tradle?
We got 3 minutes. We could get a hole in one.
I think we could get a 3-minute tradle in.
Even a birdie or maybe an eagle. We'll see what we get.
I know golf terms. I did golf.
I almost forgot what the second one was.
I forgot what all of those were. But I did do golf. So let's try to get through this. We got 3 minutes. If anybody in chat has never played with us before, we like to play this game called Tradle, which is very similar to Wordle. We're basically given the export distribution of a country, and we have to guess which country it is. So this country, for example, has $206 million in exports. Recreational boats makes up a whole lot of it. We got some refined petroleum, diamonds, asphalt mixtures. And so basically, we're going to give a guess, and then it's going to tell us basically how close we are to the target country and what direction the target country's in. So do you know anybody that makes an awful lot of recreational boats? I assume they're on the coast.
206 million in exports.
It's a little small, yeah. It's a little small, hard liquor, magnesium. Okay, so we got, and diamonds too, 5% diamonds.
That's a decent chunk, okay.
That's a decent chunk of the diamonds.
Asphalt mixtures, refined petroleum, diamonds, okay.
South Africa does a lot of diamonds. They're on the coast, but I feel like they'd be bigger than 206 million, right?
Yeah, this is really small. I would think as well. But it's not a bad start to give us at least a reference point.
Well, I would say it's like maybe not a great start because everything else is going to be really far away from it. But why not? Let's just do South Africa. South Africa. Okay, so we're nowhere near the target country. South Africa. Well, we got a point on the board. So we're 46% of the way there. The target country is 10,000 kilometers to the northeast, and it's to the northeast. So that's what that little arrow means right there. Metaphysics Magic said Morocco. Does Morocco do gold? I think they might actually do gold.
Morocco would have been
But I
a
thought
better guess than South Africa, to be honest.
I feel like Morocco does. They also don't they do phosphorus or something or sulfur, something like that.
Do they do sulfur?
Got
I don't like
hard
the smell
liquor,
of sulfur.
hard liquor in there as well. So I don't know if we got Jamaica, we got Venezuela, Maldives. I think so. I'm trying South Africa. So it's either on the northeastern side of Africa, or it's all the way up in North America. So it could be like Iceland or something. Especially with refined petroleum, it could be like Greenland, Iceland. It could be like Norway, actually, but I feel like Norway would be a lot bigger. What do you think, E?
I mean, I'm Jamaican, so
Italy?
Italy's not Italy's pretty small, but I feel like the exports is not that small.
I'd expect it to be bigger, and I'd also expect maybe like leather or more like textiles, that kind of stuff. Russian Federation countries. It could be one of the Russian Federation countries. Now I'm trying to remember my geography. We had Morocco is a good guess. I think Morocco could be interesting because that's up there in like northern Africa.
Yeah, that's
want to try it. Well, it could also be Jamaica. We can try. I mean, do you want to do Jamaica? How much
we
do
could
they
try
do
it.
diamonds?
I've never known Jamaica would have been about 5.5% diamond. That's the only thing that's throwing me off.
Oh my God, we're actually really close. Okay.
Okay.
Jamaica was a great guess. We got closer. So now we're 93% of the way there, and we're 1,300 kilometers away, and it's like pretty much straight east.
To the west. Oh, east.
To the east. Sorry, I mixed up east and west earlier. It's supposed to be the northwest. I'm sorry about that.
Gotcha.
Yes. Recreational boats. Could it be like I'm trying to remember what Jamaica is. Could it be like the Dominican Republic or something?
Oh, that's right there.
It's right there, right?
I forget which side it's on, but I believe it's right there.
Because
I mean, I'm pretty. Yeah.
That was a very good guess, though. People in chat. Do you want to try the Dominican Republic?
Yeah, let's do it.
Diamonds are only in a few areas of the world. That's right, Donna. So I'm like, there's got to be like I don't know the. I'm also trying to remember.
Diamonds are throwing me off really bad.
Right?
Yeah.
Let's try that. Oh, we're really close.
What in the world? What's that?
Haiti?
What's that? Let's do it. Let's start.
Try Haiti?
Yeah.
Let's do it. Damn. Okay, never mind.
Oh my gosh, that's still a good guess.
I always get mixed up which side the Dominican Republic's on versus Haiti. Okay, what is like right next to the Dominican Republic and Haiti? Crap. Is it Cuba? Could it be Cuba?
Cuba's right there.
You want to try Cuba?
Let's do it.
Puerto Rico, Haiti, or Cuba? Let's try Cuba.
I say Cuba first. Yeah, let's do Cuba.
Once you get to like 95+% of the way there, it's a complete crapshoot. Okay, it is not Cuba.
Oh my goodness. Okay.
Well, we got one more guess.
Oh, we got a strikeout.
Puerto Rico. I think they split up U.S. territories with like U.S. continental states. So let's do. You know what? We're just gonna do Puerto Rico.
Okay, let's send it.
There's a good. Wait, can I spell today?
Ooh, there we go.
Jesus. Wait.
What were you thinking?
It's the British Virgin Islands is the correct answer.
Oh,
which I here's the thing though. We got 99% of the way there. I don't think we could have gotten any closer without getting it right.
If we didn't do South Africa first and we did Jamaica or something, I feel like we would have said Virgin Islands at least for the last one. I don't know, but we got.
I don't know if I would have said Virgin Islands. I wouldn't have thought of it, but I guess with 200 million in exports, like that makes sense. But whoever said Puerto Rico, I think German said it the first, I believe. So I think we got pretty. I think that's pretty good. I don't think that's too bad.
56% recreational boats. I mean,
yeah.
I don't know why we did South Africa first with 56% recreational boats, but anyways, that was a fun one.
Diamonds. Like, there's not a lot of places that make that produce diamonds. So now we know.
True.
I guess U.S. Virgin Islands do some diamonds.
That's true.
That was boneless. That's for sure. Big deal donuts. I said England. Does that count? I mean, actually, well, you know what? I think that's the perfect place to leave it. We're a little bit over. But that was a fun one. We had a whole lot of chat participation, guys. So thank you so much for giving us some great ideas. I think we did pretty good, pretty well, all things considered.
90% besides for one, but yeah, it was a fun. It was
99% of the way there is pretty good. E, is there anything that you want to leave on before we get out of here?
No, that'll be it. That was fun. Thanks for taking the time to hang out with us, and that'll be it from me.
Yep, had a great time, everybody in chat. Thank you for joining us. We're going to catch you guys next Tuesday. Can't wait to try the trade till then. So everybody, good luck trading. Be careful out there, and may the rest of your week be green. Peace.
Peace.
Yeah, it is Thursday, December 12th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth with your host, Victor Jones. It's a little show where we like to explore the incentives that govern our world. It is Thursday, people, so I am rocking solo. So shout out to everybody watching on tastylive.com. Shout out to all you savages watching on Tasty Trade desktop and mobile applications. But if you want to be part of the conversation, the screen names and the running chat, all that stuff that they're situating somewhere along your screens. There's only one place to do it, and that's on Tasty Live YouTube channel. So head on over there, type in Tasty Live, find the live, and jump in. And start typing in random ass characters. Tell us whether you made money, you lost money. If Broadcom's little pop of 13% is good for you. If you had a binary position on, tell us whether you think, tell us what you think about the quantum computing breakthroughs that we've seen in error rates over the last week. Tell us what you think about that. Tell us anything. The point is to be as active in the chat as possible so we spoof the Google algorithm into putting this show and this stream in front of as many people as possible. Speaking of the people, we should say what's up to the people. Shout out to everybody in the chat. No idea where this thing starts, so I will just say what's up. Lone, Big Deal, Dave S., Absolute Beginner, Donna, I see you as well, Metaphysics, Paul McAvoy, German, and so many more. I want to say what's up to all of you. Quantum computing equals trash. Oh, that's so funny. I didn't get. I don't want to do it. I don't really get what the new breakthrough was. I watched a video like a month ago of a woman that I follow, a scientist who explains. I don't want to call them complicated, but quasi-complicated. Developments that are happening in science, and she explained Google's breakthrough and error rate back then. So I don't actually know what was news. I don't know. Some part of me is just some big cynic that says whenever this AI hype train slows down, they just throw some red meat at the wolves to keep you chomping at the bit, buying up anything smoking. More on that later. Gold $50 drop today, was a little surprise. Bought that dip via GLDM. We'll talk about that. Look at you, CT, longtime lurker, first time to comment. Love the show. I love you, and I mean that. That's not some, I'm not just giving out some pleasantry. I mean, I'm looking at you, CT, and if I could play some slow R&B jam right now and tell you just how much I love you, I would. But I'm contractually obligated to say meaningful things about the market. So I guess more on that later. Let's talk what happened in the market today. My babies, the NASDAQ cash was down 2/3 of 1%. Dow Jones down 0.5%. Russell down 1 1/3, and the S&P down 0.5%. But even in red, it seems like they continue. Even a red day doesn't feel like a red day anymore. You feel me? Do you understand what I'm saying? I guess it depends on how leveraged you were to the downside, but we just flirted with 21,820 in the NASDAQ. The valuation gap between U.S. markets and the rest of the world, the MSCI Rest of the World Index, has never been higher. Valuations have never been higher. And I know they tell me all the time, Victor, you're a trader. You shouldn't be talking about or worrying about valuations as much as you do, because that matters in the long term. What's that quote? In the short term, the markets are a voting machine, and in the long term, they're a weighing machine. In the short term, it's all about supply and demand. How many people want shares versus how many people are selling them. And if there's an imbalance there, price goes up. Doesn't matter what your fair value is on an asset. It's supply and demand in the short term. And I get that. But at some point, who is the incremental buyer? And typically that's why you see a two-sided action in a marketplace, because you need to go find a position, find a value, find a price where you have a new incremental buyer. And I guess the passive bid from all your 401ks, as long as nobody's getting laid off or it's happening slowly. I get the claims ticked up today, more on that in a bit. But as long as you guys are all contributing through your 401ks, that passive bid in the market is a monster of an MFer. And that's, I think, what anyone like me, who's crazy enough to try to fade this little window between now and expiration in December, when everybody's all bulled up on Santa Claus rally and seasonal trends. I don't know. I got something in my claw, and I just had to go try to fade this thing. And now I'm coming in here every day a little bit angry, and you can tell why. But if they could roll this, thing 3 to 5%, I'd be a very happy man going into, I guess it's not Turkey Day, the holiday, Christmas, Kwanzaa, Hanukkah, whatever you celebrate. E-mini S&P 60, 63, so off those 60, 85 numbers that we just saw a few days ago. 21.7 in the NASDAQ futures, my babies. 44.3 in the Dow, Grandpa's favorite index, and the Russell down 23.60. And the movement here, if I may say so myself, Cato Prime saying sell the NQ. Famous last words, my man. I like it. You want to come stand over here with me? I feel like I'm in the movie Braveheart. I've got blue paint all over my face, and I'm just saying, hold. They're charging at me full speed, and I'm just, hold. That's how I feel right now. Am I scared? A little bit. Do I think it's going to work out? I'm not as confident as when I showed up to the battlefield. I'm not going to lie to you. But I do think sometimes this game is about pot odds. And do I have some aspect of my account that's always long only? Sure. And the trader in me would love to see the pot odds of a left. I keep saying this, but this low volatility regime seems to me that you've got a right distributed distribution curve. What that effectively means, without using fancy words to name that type of distribution curve, is that you have a higher probability of a grind higher, a higher probability of higher prices, but the expected value of that distribution curve doesn't change, and it's offset to account for that higher probability of higher prices with a fatter left tail. And I think that's sort of the environment that we're in. VIX at super low. I don't want to say super low, right? I guess, in my personal opinion, VIX low at 1392. Not much that the market is worried about going into the tail end of this month. Perhaps, they'll start worrying about taxes, stuff like that in the first quarter. But from the market's perspective, regardless of geopolitical tensions, regardless of a lame duck president, regardless of a new administration who seems to want a little bit of smoke when it comes to bilateral, multilateral trade negotiations, all of that seems to be taken in stride because of the growth narrative we're painting. We're painting the growth narrative, the extension of the Trump tax cuts, the lower corporate tax rates, the intention of keeping GDP growing at 3% instead of the long-term trend at 2%. All of that seems to be priced in, but the question becomes, at what point is the good news priced in to its full extent? At what point does an incremental dollar already have the positivity of the next 9 to 12 months already priced in? And maybe we're nowhere close. I have no idea. At 6,100, maybe we're nowhere close. A lot of the street thinks that 6,600, they're basically all bunched in their 2025 estimates between 6,600 and about 7,000. Somewhere between there. So it's a 400-point range. So let's call the average about 6,800. 6,850. Do you want to know what Vol's telling you? Do the math. Take that 13 VIX, apply it to the 6,100 or 66. You're going to get somewhere in the ballpark of 6,650. So you don't really need all those fancy 2025 outlooks to try to figure out what a reasonable expectation of upside is going to be. The only problem with all those fancy reports is nobody gives you a reasonable expectation of downside risk, and vol does that because it is a two-way mechanism. Live by the vol, die by the vol, my friends. 1392, far below the long-term average in volatility, somewhere at 17 or 18 if I'm not mistaken. You know, 2 years, I think it was 2 years ago, I could not understand, Vince K, what's going on, Paul McAvoy, and if housing picks up next month. Yeah, mortgage rates tick down. I think I saw them at 6.6%, something of that nature, and the sentiment, the buyer sentiment, is starting to roll over as well, starting to look a little bit more positive. So those two things could happen, man. And if those two things happen, you get people buying washing machines again. You get people buying, you know, carpet, getting people in the house, working on the house. You know, that's a big part of, you know, driving purchases in the economy. We've been missing that as the housing market's been locked. It's possible. But some part of me continues to see, you know, some part of me wonders, when we saw a higher inflation rate, what was that, yesterday? All the days blend together. We saw a higher PPI this morning, 3%. Okay, we saw a higher PPI, not by a little, but by a lot. Let me pull this up for you guys, just in case you didn't see it. I'm sure you did, but just in case you did not. Vol underestimates the downside, in my humble opinion, because once it starts to slide, vol explodes. Kind of. I don't disagree, but skew is built into the market post 1987 for that exact reason. But I would say vol in general tends to be a little bit overstated. I do see what you're saying, though. I do see what you're saying. Anyways, the PPI actual on a month-over-month basis, 0.4% was the actual versus the expected at 0.3%. Year over year, big damn deal. 3% versus the 2.6% expected, and the prior number was 2.2%. So there is no more hiding from the reacceleration of inflation. The only question is, how high does this go? How long does it take producers to pass these price inputs? PPI is seen as a little bit more of a leading indicator versus CPI, which is a lagging indicator. PPI indicating what producers are paying, which likely means what they are going to pass down onto the consumer later. If they had to pay a higher price in the purchasing of their products, the likely next step is to pass those things down to the consumer, which means the expectation is later on a higher CPI, that these costs are passed down. But even on the core, 0.2% came in at a consensus, but on a year-over-year basis, 3.4 versus 3.2%. My thought process coming into this week, sometimes I just think the opposite of what is easy will happen. Sometimes that works out. Sometimes it's more simple. So in my mind, and I even read a couple of reports that warmer inflation data will take yields higher. And I thought, that's not nuanced enough. This is, I'm explaining to you why I'm wrong. I felt smart at the time, but I'm explaining to you why I was wrong. I thought coming into this week, a warmer than expected inflation print would result in two things. I thought it would result in a slightly higher front end of the yield curve. In other words, I thought the 2-year would stay high and maybe even lift a little bit. What is that really saying? What that's saying is that if we got warmer inflation prints this month, what was the effect is that the market would take out some of the Fed's ability to cut, their expectations for the Fed to cut in the short term. And the 2-year tends to be this representation, this market representation of Fed expectations. So if the short end floats higher, what they're effectively telling you is over the next 2 years, within the next 2 years, there's a lower expectation that the Fed would move rates lower. After CPI, in a way, we saw that. I'm going to show you why that is. We were something at like 88% of a cut this week. We've moved up to 96, 97%. So they cemented the December cut, but that's not the entirety of the story. What's also true is coming into this week, we had about 3 additional cuts priced in to 2025. There was one in March, there was one in June, and then effectively there was one between October and December. But that one was a lower probability and the timing was less clear. And what had happened after CPI, they took out the probabilities, or they took down the probabilities of that third cut. And today, with the higher PPI, they threw it out. They threw it out completely. So your probabilities of 2025, the amount of cuts that have been priced in at this point, is basically 2. And that sort of makes sense. Where are we in terms of Fed funds rate target? We're at 450 to 475. Take out 2 cuts, and you are 4 to 4.25. What is your 2-year? Your 2-year is currently 4.165. It's literally in the middle of that range, for between 4 and 4.25. I could go look at SOFR futures or Fed funds futures, all that stuff, but as a nice back of the napkin for us traders, you can just look at the 2-year and go, the market took out a lot of those cuts and is expecting over the next couple of years a range between 4 and 4.25. So that's kind of what I would be expecting for next week, which is the 18th. The Federal Reserve will put out their expectations for what they're going to do in 2025. But I kind of think the work's already been done for you. And I think that's what happened in the marketplace today. But what I thought, because the market has done so much work to raise the short term, that perhaps that may be giving more confidence to the long end of the market. And maybe you would see a little bit of buying in the long end, and maybe you would even see an inverted yield curve. But the market's not ready to do that, and the market is dragging the long end of the curve up with it. So we are, the market is not looking like it wants to invert in any way, shape, or form. So ZB has sold off of that 120 level into 117, into this digestion range here. It's sold off deeply into it. So it looks like the yield curve is going to stay positive. It wants to stay positive. It's going to stay positive. The difference between the 10 and the 2 coming into the day was about 14 basis points. So the 10-year, which should happen over time, your longer tenor should be trading with higher yield because there's more risk that something happens over a 10-year period to the payback of your money versus 2 years. You loan somebody money, things can happen within 2 years where they don't pay it back or the money's not worth as much. 10 years, there's a higher probability something goes wrong, so typically you demand more risk for those longer dated maturities. I know most of you know that stuff, but just in case. So you're seeing the 10 years trading with only 14 basis points more built in, but it is positive nonetheless, and it doesn't seem to want to reinvert, which means you sort of got to respect the 2-year here. I try to get cute and think we might see a reinversion. It doesn't seem like the market wants to do that. It seems like the market wants to keep yields positive. And if that's the case, the long-term trend between the 2 and the 10-year is 100 basis points. I saw Ophir Gottlieb post something on this today. The long-term difference between the 2-year and the 10-year is about 100 basis points. So if the 2-year right now is trading at 4.165, the long-term averages would say the 10-year should be somewhere in the neighborhood of 5%. That you should see an additional 100 basis points for the yield of that 10-year. And I've maintained that I do think that is in the cards. I think the path of least resistance for 2025 is a 5% yield. But I did think that they would, I thought bonds would do a little bit more work to the upside here. But I guess we're in this range. And I'm going to trade the range unless it's violated, right? You trade between 115.5 to 118.5 was this established range. We did a little peekaboo above the range. The question is whether we'll establish a higher low or a lower low here. I'd still like to play for the higher low. For some reason, I think it's not going to be that easy. Bonds don't move in a straight line. but the market may make a fool out of me here. It may, we may be trading at 114 in the next 2 weeks, and I'll say, well, I didn't get that one right. But we'll see what happens here. And you can see that this kind of range that it was trading in, we saw that back in mid-year as well. The same exact range between 115 and let's call it 120. We're doing something similar now. And I'm going to play that range. We'll see what happens. Paul McAvoy says, me too, play it higher. That's what I'm doing, my friend. I could totally be wrong. And again, it's a weird sort of thing because I'm playing the counter trend. I'm playing a long bond position, even though I think over a 12-month period, I think the steepener works. I think we steepen, and I think that 10-year probably is at 5% as we steepen. Let's see what some of you guys are saying. I'll stop. Let's read the chat for a second, react to the chat, and then we'll get going. We got a ton of topics today. The 10-year 3-month is almost positive. That's right, absolute beginner. And my man who did all of the work, this is the thing about all these signals, right? So they come up with the SOM rule. The SOM rule's violated. They get Claudia SOM to come on television, tell everybody it's different this time. I believe our good friend, I'm blanking on the name, the person who came up with the 10-year 3-month rule as being the most important of the yield curve inversions to look at, I think is also being paraded around saying the same thing. I think I read in an article. It's different this time. Everybody, it's different this time. Daniel Marquardt, overvaluation is concentrated to select stocks, but not to the broader index. Daniel, I would agree with that. But here's the problem. Not with that thinking, because I have that same type of thinking. I would agree with you 100%. You take out 7 stocks, you go, what's the value of the market? And you get something that's like sort of a normal valuation range. It's not low. I think it's like 18. So right now we're trading, I think, at a 22 or 23 forward multiple. You take out those 7 stocks or whatever, I think you're in the ballpark of like 18, 19, which is in the 5-year, 10-year average. It's a little bit warm, but it's like, it's not crazy. I hear you. But the problem with that is, so my trade construction is to buy the rest. So what I'm trying to do is be long the market, short concentration. In a way, that's how I've structured my portfolio. And if what you were saying is true, what could happen at some point is a normalization. And what could happen is either those concentrated, overvalued, or expensive stocks in terms of valuation come down and meet the rest of the market, or those cheap stocks by valuation come up and meet those other concentrated names. But that's not happening right now, right? That broadening of the rally, to an extent, is not happening at the index level. It may be happening, you're getting like these big spikes in stocks, Broadcom today moving up by 10, 13, 15% in the extended hours. You can look at it here. But, ended the day at 180. Now we're 207. So you're getting these massive reactions on stocks, big pops. But at the index level, you're not seeing the other indices catch up to the extent with where the NASDAQ value is. And that's where all that those concentrated positions are most represented. So I think you're right. I also agree. But what's the saying? Markets can stay irrational longer than we can stay solvent. And I'm not necessarily saying that stocks are expensive. At the beginning of a cycle, I've said this before, I said this to Chris, at the beginning of a cycle, you get high valuations, and then an economy grows into its valuations typically. They might be a little overextended, but what the market is doing is trying to forecast or discount out into the next 9 to 12 months. And in the next 9 to 12 months, the market has a very high expectations for earnings growth. And now they're expensive, but if you see the market grow into that earnings multiple, you'll see the price can go up, but its value can come down. That's why you can't trade. You can't put all the eggs in one valuation basket. Anyways, my point is, Daniel, I totally agree with the point of view I have a position on. that would benefit from the normalization of price and value between the concentrated stocks and those that are not concentrated. Just taking some time. If I've constructed it correctly, that's always, perhaps I've constructed the trade incorrectly. It's not the easiest thing to put on. I guess I made it complicated. It is easy to put on if you use simple instruments. Sterling Ruffin says, you want to see vol spike, let the Fed wake up next week and do the right thing, not cut rates into this higher inflation environment. Sterling, why are we the only people who are reasonable? Why are we the only? That seems like the most reasonable thing anyone could say, which is on a 3% PPI, right? On 2.6, 2.7% year over year consumer inflation levels. We're cutting into that. I don't get why the public is not furious. I don't get why they're not furious. Because unemployment's still going up. Jobs claims today, it's still going up. People are still not, this isn't a great, environment for job hunters. And that's keeping a lid on wage suppression. I don't know why people are not pissed. Maybe there's enough people that go, well, if they cut rates enough, maybe I can get a house. Yeah, maybe you can, and it'll be 20% more expensive when you can get into it. Congratulations, you played yourself. Jobless claims, 242,000 is the actual versus the consensus at 220,000. And 220 is kind of where we've been at. You can see it here. The 4-week moving average, 218,000. So the expectation was just a status quo number. And you can see there's a pretty big jump between that status quo number, which also moved up the 4-week moving average. Stuff not great, but it's a weird thing. Here's the weird thing. If companies are figuring out how to do more with less, if a lot of the consumptive power has moved up from the bottom 50% to the top 50%, if that top portion of the economy is accounting for 80% of the spending in the economy, then maybe losing jobs is not going to have a down, as negative an impact on the economy as one might normally expect, given the concentration of wealth. That's a weird thing to say. And so as you see unemployment tick up, what you're really seeing is corporate efficiency and margins, corporate profitability move higher, and not necessarily consumptive power of the economy going down or offsetting that equally. That's the weird thing to say. But somebody must say it. It seems like that's how the market is pricing this. But unemployment rate at what? Where did we end last week? I think we ticked up to 4.2%, if I'm not mistaken. Fed's initial expectations for 2024 was 4.4%. Inflation at 2.6, 2.3 headline and 2.6 core, with a Fed funds rate at 4.4%, which is about where we are, right? We're 440 to 475. They probably got one less cut off than they thought, but we're going to end up doing it in a week, which I cannot believe. Jack Murphy Live says most people won't short. I think that's true, and that's probably a good thing, Jack. I think shorting, shorting tends to be something people think about as binary. And I think when I thought about shorting as binary, usually it was a losing proposition for me because it's really, really hard to time. When I started thinking about shorting as just a basis trade, like I want to be net long these instruments and I want to be net short these instruments, and really what I'm looking for is either the market can go up, but my longs are going to do better than my shorts, or market can go down and my shorts are going to do better than my longs. I'm looking for a basis convergence. When I started thinking about shorting that way, I started to have a higher probability of success. And most of the time I keep net long deltas. And so that sort of increased the probability of success for me. And I started thinking about shorting in a more nuanced way. But yeah, I do think if you do this long enough and you're not, why not be I wouldn't be afraid of the two directions in the market. Just depends on your activity level. Cato Prime says, markets are nuts. Markets are nuts. Housing, credit, debt, wage growth is telling a different story. I'm with you, Cato. But here's the thing, man. I also know that this late part of the cycle, which I believe we're in, it can be the dumbest. It can be whatever you think is crazy, multiply it by 2. And that's why this part of the cycle becomes really hard to fade, because you get Fartcoin going up and now it's worth $560 million, which is worth more than 1 out of 3 publicly listed companies. That's the kind of stupidness you're in. And the Fed is cutting into that. So I'd be careful. I agree with you. It seems a little nuts. But sometimes, like in 2022, I think what was hard for people to realize is we were in an environment, we were leaving an environment and we were going into a new one. We were going into a new environment with higher cost of capital. And that changes the game on how everything had worked, right? Your Ubers are not going to be subsidized with cheap money anymore. The prices were going to go up. Your food deliveries, restaurants, your small business labor costs in your small businesses, all of this stuff was about to change. And the market saw it and was discounting it, but people couldn't see that future. There's a part of me that goes, the market is nuts today, but what about the next 9 months? Am I potentially not able to see that the market is projecting? What is different about that world? And because I always take it back, there were so many people that could see what that new world was back in 2022. They couldn't imagine a cost of capital and what that would do to asset prices, what that would do to certain businesses and industries, what that would do to labor costs. But, you know, I wonder if we're in the reverse of that right now. I don't think so. You know, when people are saying that the business cycle is over, to me, I'm like, all right, all right, you guys have lost it. But there's some part of us as risk managers that have to remain humble to the idea that we may be on the wrong side of a two-sided market. And I'm always humble to Mr. Market. So we talked about bond position. I have nothing on. I don't have the steepener on yet, though I'm guessing at 119, hindsight's 2020, but the best time to put this on was when we ticked at 120. The steepener would have been the best thing to put on. I think the difference between the 2s and the 10s was only 2 basis points back then. Now it's like 15. We've already widened up. That trade would be a 13 basis point winner. Again, hindsight's 2020. I'm still playing the long side of bonds. If I get lucky, I'll look to exit that long bond position. I don't know, maybe 122-ish levels, scale down, and then put on the steepener. But I don't know if I'll get that second chance. We shall see, my babies. For a second, I talked about this morning. I talked about it a little bit over the last couple of days. I want to bring it up now. I want to get your guys' opinion. Speaking of concentrated, the day after Ryan sells his Fartcoin at Rockets, he was long. Of course he was. All right, let me read a few more. You have to outbid BlackRock. Good luck with that. You're talking about houses, I'm guessing. VJ, is your portfolio at a high watermark? No, it was going into last week. So I think the middle part of last week was a high watermark. And but I've given back some in the last couple of days. But I also have more variance on. So I have basically what that means. I have more futures options on right now, and when I do this, I get bigger swings in my P&L. So there's a way that I'll have on long stocks and I'll hedge out some of that risk with short futures, and that's basically has very little variance to it. But then whenever I think I know something, who asked that question? Oh, Jack Murphy. Whenever I think I know something, then I'll put on a little bit more directional exposure, and the portfolio will have a lot more variance. So I hit it last week, and pulled back over the last 6 trading sessions. That's the way it happens for me. I'm going to hit a high watermark usually when the market's contracting on everybody else. They're going to hit it as markets are hitting new highs. People in general are lulled into complacency by the holidays and their fear of missing out on the next NVIDIA rally. What do you think? Is the quantum supercomputer from Google, is that the NVIDIA killer? You know, this has been a zero-sum game, this whole AI narrative. It's like NVIDIA is getting all of the capital expenditure from businesses through one way or another. All that spend was effectively going to really one company. Maybe Taiwan Semiconductor by extension and a handful of others, but the lion's share of that capital expenditure was going to one place. How many of you Googled septillion this week? I don't know. Is that a math joke? I don't think it is. But my point is, this thing could, just for anyone that doesn't get the horrible reference, it's not even a funny joke. This thing can do problem solving in 5 minutes that would take linear computing septillion of years. And so the joke, if you have to explain, it's not funny. I'm going to move on. But I agree, they're lulled into complacency. But this is the thing, as I said before, the last leg of the move, the late cycle move, is the most beta. That's where a lot of the beta comes from. It gets so dumb. Are we already in that territory, or can it get even dumber than where we are right now? Especially if you have a Fed that thinks we're at neutral. I don't know that they think we're at neutral so much as they think that the long end of the bond market's going to do their work for them. I don't know. I don't know what the hell. It's, are we just inflating our way out of the debt and trying to hold, like trying to pretend it's not happening as long as possible so we don't get to go to silly, what does Raoul Paul call this? Raoul Paul calls this the banana zone. I think he's got this video out there. He's had a series of videos. He's done his third one, I think, the Everything Code, I think it's what it's called. And he has, between now and 2030, is called the banana zone, where everything just goes dumb to the upside. I don't know. Institutional money can short because they can hold through squeezes. Maybe. I think retail can, depending on the sizing of the position. But I don't think people want to size shorts small enough. People see that potential of that left tail move, and they want to be the next microbrewery, so they put on positions with massive leverage that pay out these nice convex P&L graphs, and then the market just grinds higher, and you're paying out theta to the market. At best, you're paying out theta. If not, you're in some futures position where you got to keep putting up money to hold it on, and you can't. At Victor sounds like a Pokemon or a lizard. Do I? Jesus. I don't buy the hype, and I personally never have. I don't either, but I'm a cynical person by nature. Thoughts on Ripple? I don't have any. Meaning I don't have any thoughts. I also don't own any XRP. And I don't currently own any ETH. I did, and then I sold it on a rip. Every time I talk to Ryan Grace, though, he talks me into its long-term value, its long-term network value. But I have money in Bitcoin, and that's about it. Cactus Leo. NFT. This is the last one that I'm gonna really get to work here. NFT pictures of rocks and monkeys selling for millions of dollars was pretty dumb. So anything is possible. Exactly, Cactus. It was so funny. Because as we do here, any trader, you guys all have rational, reasonable positions. Why? Because the market's beaten the binary thinking out of us. As soon as you start thinking in one way trains, the market will punish you, and then eventually you get to this world where you see the world through a distribution. Anything can happen, and you approach it with reason, with caution, and with respect. So back when the whole NFT craze was going on, people asked me what I thought about it, and I said, well, is a painting worth more when you convert it to dollars? Is it worth more because it's been priced in yen versus being priced in dollars? Somebody would say, well, no. Obviously, post-conversion, it should be the same. Yeah, okay. Is it worth more if I pay with cashier's checks? The answer is no, it should be the same. Maybe there's some inconvenience fee. It's like, what the hell is this? Traveler's checks is what I used actually. And so the answer is no. So what that shows is the currency unit shouldn't technically affect the value of an art piece, nor should its method of transacting. If I wired you the money, if I paid you in cash, if I paid you with a check, if I paid you with ACH, if I paid you with a theoretical equivalent of diamonds, there's a conversion rate, and there's probably going to be a spread. There's friction on the transaction, but generally speaking, it doesn't change the value of the instrument. So my issue with that whole dumb NFT craze was nobody was judging the art, the value of the art. Everyone was thinking that the scarcity was the thing that matters most. Well, if I blow my nose in a tissue and I put it on a piece of paper, that's scarce. That's a one of one. How much is that worth? How much is that scarcity worth to you? And you start thinking about it like that, you go, well, not very much. Yeah. And that's the way I thought about a lot of those drawings back in the day. That none of them were worth the value that they were selling for. None of them. The art itself. And I'm not even an art person, but if I could look at a dope piece of art, I would say, okay, I get it. I'm not going to pay it, but I get it. Almost none of that stuff, in my personal opinion, was dope. And it was really just an expression of digital wealth. It was like wearing a Rolex or something like that. I don't know. I don't know where you are in your wealth journey, but the more I had, the less I cared about showing it to people. And I was a bank teller at like 18. And here's what I found working at a bank. The people who walk in and look like they got it, being on the other side, 9 times out of 10, they don't got it. People that walk in smelling like mothballs, they got it. And they have it because they're not trying to keep up with the Joneses and prove it to everybody, because who the hell cares? A t-shirt's a t-shirt, shoe is a shoe, an avatar is an avatar. And that was my opinion then. That's probably still my opinion. I don't know if that's the type of answer you were looking for and asking about XRP and then asking about NFTs, but that's how I think about that stuff. If I can upload a free avatar, is there any chance in hell I'm going to spend $200,000 to put up an avatar and try to impress you? No, thank you. I'm good on my own. I can think of plenty of other things to do with that money. /GC 2704. Somebody brought this up earlier. Down $50, which isn't the worst day. You know, that death candle's $100 in gold. That's why I buy my clothes at Costco. Amen. They have something called cotton on here. I just care about the materials. It took me so damn long. Okay, you got me off of this topic again. It took me so long to care about the materials that I was buying more than the brand. And when I made that transition, I felt like such a fool. You know what I mean? For my entire life to be looking for the thing on the shirt, the thing on the pants, the thing on the shoe, and not caring as much about what's actually in the materials. And then I come to find out I've been wearing stuff made out of oil, you know, these types of like non-natural fibers on my body this whole time, and paying somebody God knows how much. Anyways, Jack Murphy says all digital assets are a scam. Are you including Bitcoin in that, Jack Murphy? Are you including Bitcoin in that? I'm curious. But my point is, a $50 day in gold is nasty work, but it's not the worst work. At this level, about $100 to $150 day is like your painful drawdown. I've mentioned this before, but I did some work on gold, and your good day, your outlier move to the upside is like 2%. Your outlier move to the downside is 5%. But gold was an ugly day today. Silver was an ugly day. I think down 3%, something like this. Sleepy Mocha says. Actually, you guys like this topic. Hold on, let me see what you guys are saying. The man I work with, that's why I wear black t-shirts every day. It's not because I think it's cool. That's because I live in a hot climate. And if I sweat, I don't want people to see it. And I care about getting as close to 100% cotton as possible. Natural fibers. The man I work for is worth 9 figures, and he wears Wrangler jeans and a company shirt everywhere he goes. Amen. Amen. That's what I'm trying to teach my kids. Early, so they don't get caught up in that crazy thinking. I can't trade gold. It has bludgeoned me time and time again. Sterling, I've been in that position. In 2021, 2022, I stopped. I think in 2021, I swore I would never trade paper gold again. I went and I bought a bunch of physical gold. As you guys may know, I bought a bunch of physical gold, a safe, and a gun. And I'm like, I don't get how this moves on a day-to-day basis, but this thing should go up. So I'm going to buy the physical gold, so I can't be liquid with this thing, and it forces me to hold it. Not liquid gold, physical gold. Ended up working out. I started distributing some around 2,400. I need that mothball money. You guys are too funny. But yeah, I think gold after 2,400 became a little bit difficult because it's just creeping higher. You know, there's not really much of a two-way market, and it's not like we just like early in the year from March to April when we went stupid to the upside. So you could have some long upside call exposure, and you could get paid really quickly, and then you could take some of that money, take it out of the market, and then roll them into out of the money calls, further out of the money calls, and just keep printing. It's not like that environment. It's grinding up higher. You're not necessarily getting paid on upside call deltas, on out of the money anyway. You got to be like at the money or in the money. So yeah, I have a little bit of long gold exposure right now via calls. And I've said this before, I'll say it again. I think the more interesting play for me are the miners. I think given the fact that gold's still at all-time highs, given the fact that China was a net buyer again for the first time since May, for the first time since the May report, I think there's a big divergence between where miners are priced and where the metals are priced. The stocks could be right and the metals could be wrong, or vice versa, but I like the divergence here. You could play it the other way. You could go in and short gold saying that the miners are right, or projections of the next 12-month revenue. But I kind of like buying the miners here, and I have been this week. I don't know if, again, I like to say this because when I'm in these types of positions, this is not I think it's going to pay anytime soon. I just like the value of the entry. and the miners, I've increased the position size or decreased the position size, but I have not closed out of these minor positions. Lone says, Victor and I love our gold. That's right. But I diversified too. It was gold, it was silver, it was nickel, it was platinum. I want to say that was it. I want to say that was, yeah, so I spread it around a little bit. But mostly gold. Silver a little cheaper here today. I'm adding to the silver position here. So 30 is held. If it breaks 30, then I'm in trouble. But on this backing off of 33, this rejection of 33, I don't know. Is this little mini head and shoulders here? Should I be scared of that? Are you guys scared of that type of stuff? See if I can keep drawing this. You guys seeing what I'm seeing here? Somebody play the Jeopardy music here. Do 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 do. I'm sorry. Once I started, I had to finish. I didn't think it was going to take this long. But my point is, are you seeing what I'm seeing here? It's probably, what would a measured move of 30 to 35 be? So that's 25. That's 25 if that head and shoulders violates. My thing is, I looked at some statistics on stuff like head and shoulders. There's no edge in it. It's like there's no edge in a lot of these chart patterns. So it's great to call them out. You sound smart to somebody new. It gives you some content to talk about. But when you actually look at the percentage of these things paying out, am I crazy? Has anyone else looked at this stuff? I thought I looked at this at one point in time, or looked at a study on common chart patterns, and the payout was near 50-50. There was no statistical edge. So I stopped talking about it. But head and shoulders is so easy to pick out. You've got to put it on there. Grumpy Mike's trying to get me canceled, walking me into a topic. The Time magazine named their felon of the year. What an embarrassment. I don't know, man. I get how some people feel that way. Here's my thing. Here's what I would say, Grumpy Mike. And I don't want to get in a big political discussion here, nor do I want to encourage one in the chat. Here's my thing. I think we're at a pivotal moment in American history, and regardless of who the president is and how you feel about that person and how we've been conditioned over the last several presidencies to feel very binary as a society, and if you feel this way, you're right, and if you feel this way, you're wrong, and you're evil, and you're dumb, or you're uneducated. I think the more we as a society, regardless of how you feel about the other political side, the more we throw that stuff away, just don't even let that stuff into our minds, that binary thinking and that emotional response to that stuff, as hard as it is, the better off we're going to be. I think the stronger we're going to be, the better solutions we're going to be. If we stop hating whoever's in office, regardless of the side of the aisle, we start looking for common ground, start looking to negotiate and do deals with each other, we'll be on better footing, regardless. But I'm so tired of it. I'm so tired of this. It's like, if you believe this, you're right. If you believe this, you're wrong. And people fighting people over their political opinions. Isn't that boring to everybody else by now? Like those articles and that type of media format, how's that still paying out? People want 3-hour nuanced conversations. I believe this is what I want. I want 3-hour conversations. I want one person from one side of a discussion. I want another person from another side of the discussion. I want a great moderator who has thought-provoking, interesting questions. And I want two sides of that debate to be respectful and civil, but passionate about expressing their ideas and unafraid to challenge the other individual. That's what I want. And whether I get that through politics or I get that through podcasts, because we can't get it in the political spectrum, I don't care where I get it. but I've got a thirst and a hunger for knowledge on sort of unsolvable problems, things that are not binary with some eternal truth. And I think other people do too. I think other people recognize that some of these wedge issues are wedge issues on purpose. And let me hear your side. Let me hear the trade-offs. Let me hear the other side. Let me hear the trade-offs. And let's try to make a logical, reasonable decision, a conclusion. Isn't that where we are now? I don't want to be angry. Anyways, so that concludes your PBS. I don't know. I'll abandon that joke. I couldn't even finish it. FXI 3151 by 3154. Basically a whole bunch of nothing today. I said this a little bit in my segment with Tony earlier today. Tony and Tom, excuse me. And hear me out. I talked about the catalyst for the China trade. Oh, I don't know if you guys can hear my son singing in the background, but I apologize. Not much I can do about it. He's right outside my office door. But the catalyst here where the Politburo meets mid-year, usually they're not talking about economics. This year they did, so you got that massive jump in September as they signaled, we see a problem, we're going to address a problem. They've given some numbers, but not a ton of specifics, and the numbers they have given, the market has perceived as this isn't enough. Good, not enough. Some people that I read, smart people that I read, have said that they don't want to fire the bazooka unless they understand where the U.S. political system was going to be, so that they would wait for more specifics until after the election. We saw that. First part of December, we saw an announcement from the Politburo. We got a nice 10% spike in FXI, which has come out of the market for the most part over the next two sessions. Now, what's the next catalyst? The next catalyst, you're usually going to, just like in our system between February and June, you're going to get the first budget from the new administration. Around March of next year, you're going to get the details of China's stimulus plans. So the likelihood you keep getting these flirtatious, sexy little like lines with no real teeth, no real bite to them, probably high. But sometime between now and next March, you're going to get specifics. And that becomes a binary event once we get to March. Why do I say that? Because at that point, either their plans are going to be perceived as enough by the marketplace, or let me call it satisfactory by the marketplace, or more than satisfactory, or unsatisfactory. If unsatisfactory, then perhaps some of the optimism that has been priced into these markets gets priced out once you have the details. Hey, we're gonna put tons of stimulus in the market. We're gonna do this. We're gonna do that. Then you get the details, the size, the timing, and there's the possibility that binary event of the moving from the unknown to the known takes value out of these underlying securities. But there's also the possibility that they meet expectations, meet or exceed expectations. So I think between now and March, do I know what happens between any of these instruments? Absolutely not. I do not know. But I do know that in March, we're going to get another one of these catalysts. And we saw the September catalyst. We just saw the December catalyst. And in March, we're likely going to get another one. And the question becomes, for anyone that wants to take on this trade, what side of that trade do you want to be on? Do you want to trade that binary event risk or not? For me, it's yes. I don't know that we're done here. I think at some point, the back and forth between China and the U.S. seems like it's going to escalate. Even what did the NATO chief today said? Let me read you the direct quote. If this doesn't make you nervous, I don't know what will. But they'll say anything. Directly from the NATO chief here, everybody. NATO chief, we will need a lot more than 2% of GDP for defense. We are not ready for what is coming in 4 to 5 years. It is time to shift to a wartime mindset. A lot of the projections I've seen for an escalating conflict with China are on a 4 to 5 year time horizon. So I think the possibility that tit for tat starts to warm up here, and what does that mean for FXI? What does that mean for U.S. listed Chinese equities and the ability for U.S. investors to get exposure? What does that mean for listing or delisting over the next 4 or 5 years? What are those are those projections any good? Is that something you sort of have to say because you see the other side increasing their military spend? I don't know. All I know is that these things are still cheap relative to their U.S. counterparts, and there's a catalyst in March, and I still want to be long, and I will be long, and we'll see what happens in March. I have much smaller position size than going into September. This massive move of like 25% over a 2-week period was enough to cash out some of that. I think 60% of the position, but I'm still going to stay long into March. And then we'll figure out what we do after that. And I know everyone says how bad their economy is, but I don't think I'm playing an economic recovery. So there's some part of me that doesn't think I'm playing an economic recovery here. That could be a kicker. Some part of me thinks I'm playing, this is sort of a currency play. That this is how much liquidity are they going to put into the market. Plus they have capital controls, so the liquidity they put into the market doesn't necessarily go out to the rest of the world like our liquidity. Their liquidity is more targeted to them, stays there in that Chinese circular economy. And in that world, if they have a rising liquidity environment, I think that's all I'm playing here. And so as much as people hawk about how bad the economy is and how bad, that they could be in their next GFC moment here and that the real estate market's cratering, that people are nervous about the future, that they're taking pay cuts. I get all of that. I think the worse it becomes, what are they going to let it do? Are they going to let it implode on itself, or is there eventually a stimulated response? Or a devaluation of the yuan? Probably. So I think that's what I'm playing here. All right, let's see what you guys are saying real quick. Let's see. My opinion of him. Let's see what you guys are saying. I just want to have the ability to debate again. Amen to that. My opinion of him was formed back in the Central Park 5 days. Not going to change now. Yeah, I get that. I definitely get that. That was not a cool move at all. Let's see Vic Jr. I would, but the door's locked, I think. If it's not, he'll come in. I'm basically in the same boat, Mike. Trump makes a lot of people irrationally angry. I don't know if it's irrational. I think some of it's well-founded, but I just think, it's that old saying, being angry at someone else. If he never knows you're angry, does it ever hurt anybody else but yourself? In this particular case, does being mad at the president ever hurt anyone else but yourself? You know what I mean? It's just like, why? If you don't want to be angry, make the choice. Make the choice. It's very difficult to have rational discussion when his entire way of operating is to act as a sort of angry troll. Yeah, I get that. I get that. Here's the other side. The other side is, regardless if the person in that seat is eloquent and delivers the words the right way that offends the least amount of people. If that person has bad policy, is that better than having a bull in a china shop who has policy that may positively impact communities, economic policies? Is that better? I don't know. Sometimes I go back and forth. I want both, right? I didn't have the choice for both this time around. At least I felt. And so when push comes to shove, what do you vote for? The representative, the figurehead, the look, or is it the policy when push comes to shove? I don't know. He used the most divisive language I've heard come from any president. I will say that. I agree with that. There can't be a return to some sort of rationality. This is the last one I'll do. There's return to rationality, someone like that at the very top. I do, of course, appreciate Victor being a bit of a contrarian voice. He has a way of getting you to think a little bit more about it. I appreciate that. It's a hard little line to dance on because I'm trying not to piss people off, but I'm trying to just do the Confucius thing where you just ask questions. And by asking a question, it creates an open space for somebody to think about a side of the discussion that perhaps they haven't thought about in the past. Doesn't mean you're wrong or the other side's right. It just means there's a ton of room for understanding of people's points of view. In other words, here's what I mean. The person is less important than the 75 million who supported that person. So let's try to understand the 71 million, try to understand the 75 million, and the 75 try to understand the 71. To me, that's more important. That's the most important thing. But we're being sort of tricked into thinking we got to stay in our own echo chambers and not to listen to the other side. And so there's never any understanding. There's never any negotiation. There's never any pressure on our political representation to make deals that would make progress on the biggest problems facing the American people. And by doing that, we give them a free pass. If we never listen to each other, we give our representation a free pass not to do any work. And so I think that's why the last Congress passed the least amount of bills of any in history, something like this. Let me not say that because I don't know that offhand. I thought that's what I read, but it's been a while, so. Yeah, my point is like, let's stop giving these people a free pass, regardless of who they are. Let's inform ourselves on the issues. Let's listen to each other. Let's find common ground, and then let's force or put pressure on our politicians to implement the solution that we've agreed upon. That's what elected representation is supposed to be. Not I show up 4 years, push a lever, and hope for the best. All right, let's keep cruising. I don't know why I always do that. I always fall into that trap. Bitcoin 100,000, just floating at this level. I kind of love everything about that. Going back and forth over and under 100,000. I'm not going to reopen this can. I don't think there's much to say. I think the only interesting play on Bitcoin in the short term is IBIT options. I think these things are not that bad. 20 cents wide at the money for such a volatile asset. Look at the open interest. I'm looking at January here with 36 days to expiration. Tons of open interest. Not only that, you're seeing open interest up and down the chain, which means you have pretty decently priced vol. So when you look at 67 vol, you can have pretty good confidence in those numbers given the participation you're seeing up and down the chain. You've got real decent pricing. So I'm pleasantly surprised with this stuff. And I think, if we're just going to play on both sides of 100,000 here, I know this is recency bias. Just because we crossed 100,000 didn't go anywhere for the last week doesn't mean that's where we're staying. My point, though, is the winner of the last week and a half, 2 weeks of Bitcoin are the new vol sellers. This is something we couldn't do up until a month or so ago. We've now got 67 vol priced into IBIT with 20 cent. I know it's wide, but it's not horrible. So I think that's the real winner here until we decide whether or not to break higher from 100,000 to 115. Then you're in trouble a little bit. Maybe a Jade Lizard makes a little bit of sense, right? Sell that downside put, sell a crawl spread to the upside to harvest some of this volatility premium, but you don't want to get caught naked short Bitcoin on a move to the upside. Maybe that makes a little bit of sense here. What say the audience? What say the people? Just like it did at 70K, it'll jump to 125K in a few weeks. Kyle, That was my thinking, but I didn't think we'd pause at 100,000. I thought the more interesting outcome would be to run past all of those sells and sell stops at 100, get people chasing. I thought we'd be at 115 in a blink of an eye. And then you get people chasing. Then I thought we'd retest 100. So this has already been a path that I did not expect. I don't mind saying that. I don't got to be right on everything or anything. But I got to be honest. So 56.92, I like the idea of probably selling vol here. I like a Jade Lizard. Am I crazy? Absolute Beginner says I'm long the 65.69 call spread 1-3 expiry lotto ticket. That's not as much of a lottery ticket as you would think, Absolute Beginner. What I'm saying by that is look at the chain. You think 65.69 is a lottery ticket. Look at what people are betting. I mean, even buying the asset and selling these 72 calls for $1, decreasing your basis by $1. I mean, there's some really, really interesting stuff you can start doing with iBit. And I love doing this. I was trading on a local U.S. platform that was bought out by FTX. Now I'm forgetting their name. But they offered Bitcoin options. They were illiquid, and they weren't centralized. They weren't on a centralized exchange, but they were good enough. And this was one of the things that I loved, that I could sell deep out of the money calls against my Bitcoin and harvest additional yield, because gold has that reverse skew. So all the vol is pumped into the calls. Same thing in Bitcoin. You get a reverse skew. You get a ton of that upside call demand because people are trying to play those lottery tickets that you just said. And if you own the underlying asset, you can harvest that premium against it, and you can go super dumb out of the money. 72 to reduce your basis on a 57 buy. Why not? Crazy is subjective. That is also true, my good friends. Anyways, I spent enough time there. When it comes to Bitcoin, that's what I think is interesting. I'd move over to iBit versus trading the underlying here. I'm still long the underlying, and that's just opportunity cost as it goes nowhere. I was hoping we'd get a move above 110, somewhere into the 115 level, before I started to give some of that back up. I think below 88, I start to rethink my position and probably lock in the profits that I have. Where did I want to go? Oh, the next are outside of the U.S. So we talked about earlier concentration risk within the United States. I'm starting to look at and deploy some money towards stuff outside the U.S. I told you before, what's on my shopping list. Stuff like Europe is on my shopping list, but I don't think they've done enough damage to Europe yet. If you look at a long enough time frame, it's still trading near its highs. So I don't love it here. VGK is what I'm using here to express the position. There are